Good morning. If everyone wants to take their seat, we'll get started. Okay, that's what I thought. It's the first test. All right, good morning to everyone in the room and to those watching via live stream at consumerfinance.gov. My name is Andrew Duke. I serve as the Bureau's Policy Associate Director for External Affairs and Consumer Education and Engagement Divisions here at the Bureau. Welcome to the Consumer Financial Protection Bureau's Symposium on Consumer Access to Financial Records in Section 1033 of the Dodd-Frank Act. Today's event is being held here at the Bureau's headquarters in Washington, D.C., and this symposium is the fourth in a series announced last year to explore consumer finance protections in today's dynamic financial services marketplace. In a moment, I'll have the honor of introducing the Bureau's Director, Kathleen Kraninger, who will provide you opening remarks. Before I do so, let me tell you about what you can expect at today's symposium. Following the Director's remarks, the Bureau's Assistant Director in the Office of Innovation, Paul Watkins, will moderate the first panel discussion, which will assess the current landscape of holders of consumer data and the benefits and risk associated with consumer-authorized data access. The first panel is scheduled to end at about 10:40 a.m., after which there will be a brief 10-minute break. The second panel will begin at about 10:50 a.m., and it will be moderated by Will Wade Gary, Senior Advisor in the Bureau's Office of Innovation. And it will include a discussion on market developments in consumer-authorized data access. The second panel is scheduled to end at 11:50 a.m., after which there will be another 10-minute break. At 12 noon, the third and final panel will begin, moderated by Tom Devlin, Managing Counsel in the Office of Regulations. This panel will focus on the future state of the market as well as on considerations for policymakers on how to properly safeguard consumer data while ensuring that consumers have continual access to their data. The symposium will conclude at about 1:10 p.m. For those unable to attend in person or watch via live stream today, a recording will be made available on the Bureau's website. Finally, as a friendly reminder, the views of our panelists today are their views. They are greatly appreciated and welcome, yet they do not necessarily represent the views of the Bureau. It's now my honor to introduce Director Kathleen Kraninger. Director Kraninger became the second confirmed director of the Consumer Financial Protection Bureau in December 2018. From her early years as a Peace Corps volunteer to her role establishing the Department of Homeland Security, to her work at the Office of Management and Budget, now to the CFPB, Director Kraninger has dedicated her career to public service. It's my privilege to welcome her to the podium. Director Kraninger, the floor is yours.
Thank you, Andrew. Good morning, everyone. I am very excited to welcome you to today's symposium on consumer access to their financial records. I'd like to thank all the panelists for participating today, as well as our Bureau moderators, Paul, Tom, and Will. Our Symposia series convenes experts from a variety of fields and backgrounds to consider legal and policy issues. This is our fourth symposium, and the series is proving to be very useful to us, and I hope to all of you. Our goal is to facilitate a robust and productive and proactive dialogue with experts reflecting diverse viewpoints across a range of subject matters. Through that dialogue, we hope to glean common sense ideas to help in solving a number of challenging issues facing the Bureau. In turn, those ideas will help inform the Bureau's policy development process. We have already held productive talks on behavioral economics, small business loan data collection, and abusive acts or practices. And we're putting what we learn into action. For example, our symposium on abusive acts and practices last month supported our issuance of a policy statement on how we intend to apply the abusiveness standard in supervision and enforcement. Our focus today is on consumer-authorized data access. We are seeing a lot of this in the marketplace right now. Consumers authorizing one company to view or collect their financial account data held at other companies. The purpose is often for delivering new products and services, often through an app on the consumer's phone. For example, if a consumer is looking to better watch their spending and save money, there are third-party apps that try to alert them to when they have reached their spending limit. There are also companies offering consumers chances to improve their creditworthiness by authorizing the review of additional data from a range of new sources not previously considered in traditional credit scoring models. And we have credit providers changing the market by streamlining and expanding underwriting enabled by new consumer-authorized data sources, such as the cash flow record associated with the consumer's bank account. To be clear, consumer-authorized data is not new. Financial institutions, typically the source of such consumer account records, were the first entities to make significant use of data gathered with the consumer's authorization. Back in 2001, it seems like a really long time ago, in what may have been the first statement by a regulator directed specifically at aggregation practices, the Office of the Comptroller of the Currency cautioned its regulated banks about certain risks associated with aggregating financial records for their customers. Some of the regulatory questions raised by the OCC nearly 2 decades ago are still with us. In 2010, Congress authorized the Bureau under Section 1033 of the Dodd-Frank Act to help ensure that consumers have access to their data and the ability to leverage it. A lot has changed significantly over the last several years, which is why we are talking about this today. 3 changes stand out. First of all, the range of actors involved has expanded greatly. Second, the extent to which they are using aggregated data to provide new products and services to millions of American consumers has grown in scope and scale. And third, technologies that enable safer and more efficient consumer-authorized data sharing continue to evolve and proliferate. While some financial institutions offer services utilizing consumer-authorized data, today it is a wealth of third parties, many of them loosely classified as fintechs, that are most prominently delivering app-based services using data authorized at the direction of consumer. The services they provide, sometimes directly to the consumer and sometimes indirectly through other companies, continue to expand and range from investment advice to fraud prevention. The consequences for consumer welfare may be significant and beneficial. Consumers having the ability and the right to authorize the use of their data by a third party could hold the promise of creating new products and services, sharpening competition, and expanding and improving the terms of consumer access to financial services. At the same time, it is imperative that consumers have control of their data, understand how it is used, have assurances that security will be maintained, and have a way to resolve problems related to data sharing should they occur. So today we are here to understand how consumers can benefit from this market, as well as to explore what risks might block or detract from safe consumer-authorized data sharing. We want to learn more about the roles played and challenges faced by different players: consumers, data holders, data users, data movers, and consumer advocates. In 2017, following a public request for information, the Bureau released a set of non-binding principles to help define how consumer interests in sharing their data might be best served and protected. The principles rightly noted that many consumer protections already applied to this market under existing statutes and regulations. However, it is worth noting that the Bureau's approach in this area throughout its entire history has been focused on identifying and promoting consumer interests in access, control, security, privacy, and other areas, and allowing the market to develop without direct regulatory intervention. We come to you today to take stock of this approach. Our first panel will discuss stakeholder perspectives on how this market can operate most effectively and efficiently. On the surface of some consumer finance conversations, we find that consumer advocates and industry representatives present longstanding and diametrically opposed views. Today's discussion starts in a very different place. The complexities and perspectives are multidimensional. There are a range of views, even within industry, and amongst consumer advocates on how best to serve consumers. We have a full agenda, but I am pleased that we have assembled a group of experts that are equal to the magnitude and complexity of the material. To all of our panelists, I am so glad that you have volunteered your time to share your thoughts with us today. I thank you for your participation, and I truly look forward to the discussion.
Thank you, Director. This time I'd like to invite Paul Watkins and the first panel to come up to the stage, please. And with that, Paul, the floor is yours.
Well, thank you, Andrew. Thank you all for being here this morning. I heard birds chirping outside, so maybe this is the first day of spring. And thank you to our panelists for being here. As was mentioned, I have the privilege of running the Bureau's Office of Innovation. And I'd like to introduce our panelists to my right, starting with Becky Heironimus, who is the Managing Vice President for Digital Enterprise Customers at Capital One. John Pitts is the policy lead at Plaid. Natalie Talpas is the Senior Vice President, Product Group Manager for Digital at PNC. Christina Tetrault is Senior Policy Counsel at Consumer Reports. And Nick Thomas is Co-Founder and Chief Technology Officer at Finicity. We're anticipating a lively discussion. I can tell you I received this scar just from moderating the pre-panel conference call. And I want to start where the director highlighted with consumer interests. We're pleased to have Consumer Reports here, so I'll direct my first question to Christina. And it's a personal pleasure to have Consumer Reports. I got to tell you, when I was a kid, I would go down to the local library, and they had this publication for kids called Penny Power, and then it was called Zillions. And you taught me a lot about how to buy a radio control car, acceleration, and which bumpers would break the easiest. So not a lot has changed for me in 30 years. You're still teaching us about products a little bit more complex than radio control cars. But let me start with you and ask you to kick off our discussion by identifying what you see as potential consumer benefits and potential consumer risks for consumers around data access.
So good morning. Thank you for the opportunity to be here and for hosting this important meeting about this topic that affects all of us. Because of data sharing, the universe of products and services, particularly financial products and services, is improving. So what we're seeing consumers take advantage of is having a clearer picture of their financial life. We're also seeing tools that automate and speed up what can otherwise be difficult or boring tasks, such as savings and paying down debt. And then we're also seeing, and I know this will be talked about in more detail later on today, better assessment of ability to repay, so potentially better credit worthiness. However, there are a number of risks, and I want to highlight sort of the big picture risks, is that the consumer decisions around permissioning the use and access to this data are incremental, but the effects are cumulative. And so if you think about what types of privacy harms consumers can be subject to, and you think about whether or not surveillance itself is its own privacy harm, then there are a lot of open questions. And so the most important, I think, is right now, there is this open question about who's in the best position to permission access. There are open questions around who's liable if something goes wrong, and I'll leave that very open-ended. And then I think there's really some existing practices that are suboptimal, just even in terms of accuracy, right? So are the products that consumers are getting, are the services reliable because is the data as accurate as it can be?
In light of those considerations, Nick, who should decide whether a third party can access a consumer's financial data and what standards should be applied?
Yeah, it's a great question. Obviously, there's we know that the consumer should be able to permission access to their data wherever they want, but there's also a safety and soundness concern in the ecosystem that we need to make sure that good actors that are behaving in the right way are able to serve those consumers in a way that's beneficial. And so I think that it is a balanced approach that needs to be taken. That actors that are benefiting consumers are able to accept the data and use that data properly once it's been permissioned by the consumer.
So let me try to drill down on what that standard should be. I think we have some TCH members up here on the panel. Natalie, let me start with you. I think there was a proposed model agreement that mentioned things like reasonable security practices and potentially business guidelines. Mm-hmm. What sort of if from the perspective of a FI, what sort of standards should be used by an FI when determining whether data access should be allowed?
Yeah, that's a big question. But wanted to thank everybody for the invitation to be here today and appreciate the CFPB's attention to this really, really important topic. I think overall, the way PNC views it is, we really want to be able to give our customers control over their data, as Nick said, in a safe, secure, and transparent way. And what that requires is a truly clear, transparent, concise consent, the ability for the customer to have control over what data they share so that it's aligned to the expectations of their use of the application. And they should have an opportunity to ensure this being shared in an efficient and secure way. Screen scraping, which is the current method in which data is collected in the majority of ways today, has reached its peak of benefit. There's a number of concerns associated with that. And so for a more secure, efficient way would be through APIs, which is what many of us on the panel here today are working towards. And those concerns are because, again, the consent's not clear. Screen scraping enables all of the data to be collected that a customer would access. Customers having to turn over their user ID and password to these financial applications to collect information today. And we have a lot of security concerns about that. So safety and security is an issue, not just in the breadth of data that's accessible, but also the sensitive consumer data that's being accessed, stored, and then shared beyond the data aggregators' walls with the fintech applications that are creating these unique experiences for customers. And so, the model agreement, yes, the clearinghouse worked towards enabling a mechanism that would allow banks to understand what's the starting point? How do we even get started here? Allow them to scale, allow this effort to scale beyond just the clearinghouse owner banks, and start to educate folks on what are some of the important aspects of it. At PNC, we think data security is fundamental in these agreements, and understanding when you have entities that have access and are storing the same type of information that we as financial institutions store and that our customers trust us with to keep secure. When you have this type of data outside of our walls, we think it's very important that those entities are subject to the same type of federal supervision for cybersecurity standards that banks are. And so I think you'll see references to that within the model agreement. And I think it really prompts the right kind of discussions that need to take place in this space.
John, how do you see these issues? Who should decide whether a third party can access financial data, and what should the standard be?
So I want to start by saying I agree with a lot of what Natalie has said here. And I think the important thing is to understand that the consumer has already decided. Right? We are not sort of talking about a future state where consumers might do this. Consumers have already voted with their thumbs that this is something they want, and these third-party services are something that's important to their life. And so I think our shared objective is to make sure that having made that decision, the consumer is safe and can be confident in that decision. And that requires work by all of us and, frankly, collaborative work by all of us. Everyone here is a member of FDX, the Financial Data Exchange, where we're working on a common API standard to improve just that. I think the concern I have is as you transition from the screen scraping environment to the API environment, how do you make sure that consumers don't have their choices restricted from what they are currently? And one of the risks, and I'll just say it's a risk, is that if every player is independently deciding which app is okay for their customers to use, they may override a decision that a consumer has already made. The consumer may have already said, this is something I want to use, it helps me in my life, it benefits me. And the consumer shouldn't have a different set of apps and services that they can use based on where they bank. It should be universal, it should be something that they expect no matter where they are. And the risk of having those decisions made too piecemeal are that you end up with a siloed market where everyone is sort of playing in a little walled garden, but consumer choice is restricted as a result.
So again, going back to the example I threw out there, and I understand there are many examples, many model agreements, but at least one of them has data standards, business guidelines. John, do you agree with both of those? Do you agree with neither?
So speaking specifically to the TCH model agreement, I actually think it is a really valuable resource in advancing some of the discussions that we have. One of the biggest difficulties that we see is negotiating agreements with 10,000 different financial institutions is very hard to scale. These are new agreements, and so having something that can narrow the bounds of that debate is helpful and useful. That said, I think there are some pieces of it that I would disagree with. I think whenever you give an individual FI the ability to say, we don't want to approve of this use case. And so for everyone, use case is not arguing about which data the consumer has access to, but how the consumer is allowed to use that data. I think you end up in a situation where the consumer's choices could potentially be vetoed by an FI. And so anything along those lines feels like it is starting to interfere with consumer choice, unless it can be really specifically tied to, for example, a real risk of fraud. And if there's a real risk of fraud, the consumer should be protected, and it's something that we all should work together to make sure is happening. But in an ecosystem this complex with this many pieces, unilateral decision-making is not actually even the most effective way to make sure the consumer is safe. It really does require a collaborative network of banks, aggregators, and fintechs working together to ensure that the consumer is protected.
Becky, if I can turn things to you, is that an adequate standard for an FI that's receiving these requests through an aggregator, risk of fraud, or are there other things that you would also want to look at?
I think as an FI, we're the steward of customers' financial data and customer data. And I agree with almost everything that's been said here, which is consumers have the right to permission how they want their data used and what data they want used. But it has to be done in a transparent way so the consumer is making an informed choice of what data is going where and for what reason. And those choices have to be honored throughout the ecosystem. And I think that's the key. Yes, obviously, there's a lot of concerns with financial data. Fraud is one. Any type of harm to the consumer is in general something we have to be concerned about. And so we have to make sure that the consumer is aware of any harm that could come from them from sharing the data, and that we are doing everything possible to protect that data by working together to create innovative ways to share the data or to make that use case happen. Sometimes we can make these use cases come to life without having to share the data. And so I think we have to really work through the best way to ensure that we're enabling the use cases the consumers want, but that doesn't always involve straight up sharing the data in the clear. And so I think we have to really think through the security and harm that can come to consumers, and we have to think technology is changing every day. We have to continue to evolve and make sure that we're evolving with it in this space.
Any further comments on this issue of data access? Natalie?
Yeah, I think I'd like to comment on a couple of things that John had said. I think I would disagree with the statement that the consumer has decided. I think we would love to be able to say that the consumer's decided. I think that's the future state that we want to get to. But I think the fact of the matter is that today they're not able to, because the consents are not consistent, they're not transparent, and they're not clear, unfortunately. And I think the clearinghouse conducted some research in the fall that demonstrated that our consumers unfortunately don't understand what they're agreeing to. They don't know that there might be an intermediary or a data aggregator that's also collecting the information. There's one application out there, just in my playing around with it several months ago, had said, we use, don't worry, we use bank level security. And also, don't worry, we're not going to store your user ID or password to collect the information. But they didn't share that, but our service provider will be storing the user ID and password. So I think we're aligned that consumers should be able to make those decisions. But the fact of the matter is that the existing CFPB principles aren't being met in that today. And I think that's what we need to focus on, is all of us aligning to ensure that we can improve that consent experience as quickly as possible.
Go ahead, Nick.
Yeah, so obviously, we're working together through the Financial Data Exchange to create standards for consent screens. We're discussing use cases, so data minimization is a big part of the vision and mission of FDX, and trying to understand that a certain set of data may be less risky than another set of data. And when I said in the beginning, very simply, that we need to take safety and soundness into consideration in how that data is shared. We need to be able to be transparent about the way that consumers, that they understand where their data is going. And so at the same time, we don't want to minimize the amount of data that's possible, the use cases that have been in the market for up to 20 years. And so as we transition from traditional data aggregation to API-based aggregation front-ended by, tokenized access, we need to be very careful in the way that the industry evolves so that we can continue to provide those services to consumers that they have chosen today. And so, that's really what we're trying to accomplish within FDX is to create that framework.
And Natalie, to your point, following on from Nick, I think it's also important to recognize and pull back a little bit how much has already been done to improve this ecosystem and how much aggregators have contributed to that, right? It used to be that each fintech app would collect the credentials themselves and use those to sign on, so the credentials are in potentially hundreds of different places. It used to be that each one had their own consent screen, and so the consumer may see a totally different consent based on which app they are using, or if they're being redirected to the FI, they may see a totally different consent based on what that individual FI thinks the consent should look like. I think there's already been substantial improvement by aggregators taking the credentials themselves and not letting the apps have them, so that they're now in one place as opposed to many. That's already limiting credentials in the ecosystem. Plaid has rolled out a single consent screen that every single consumer who's permissioning an app goes through, that's consistent across all of them, where we clearly introduce ourselves to the consumer, identify Plaid's role in the data sharing, and make sure that the consumer understands it and sees it every time they connect something. So I think there are still improvements that we need to make. We all want to get credentials out of the ecosystem, and we all want to make sure consent is the right consent for the consumer. But not recognizing how much has already been achieved and sort of only looking to all of the things that have to be done all at once in order to get the ecosystem to an ideal position, I think doesn't recognize the reality that we are in a dynamic and continuously evolving ecosystem where the consumer is active today, and we need to make sure that the consumer can continue to do what they want while being safe.
Christina, from your perspective and what you're hearing from consumers, are we currently at a place where you're comfortable consumers have the information that they need to make these decisions? And if not, what future state of the world would cause you to say, okay, I'm comfortable now that I think consumers have the information they need?
Sure. So I'm First of all, I do want to recognize the progress that's been made, and we're members of FDX and fully support meaningful consent and are eager to see some additional opportunities are eager and support the development of additional opportunities for consumers to make meaningful choices in this environment. One thing I want to point out there is sort of at the 70,000-foot level, and this is not just financial services, is that privacy policies generally are broad and sweeping. And so they include such helpful information as we collect your information for analytics. We share with trusted partners. That type of information is not helpful, right? And then you sort of add to the fact that consumers don't actually read these policies, often because it doesn't make economic sense. I mean, there's research out there that shows the insane number of hours that you would need to dedicate just to read privacy policies to get through your day, and yeah. So I just want to, and one of the things is that we also see, and this is not unique to financial services, is that there are multiple layers of agreements, right? So you may agree to a service provider's agreement, and embedded within that agreement are multiple other agreements. Or there may be, for example, multiple agreements per service provider that are separate, but again, they have this economic cost to actually having to dig into them. And so I think it's really tricky, getting back to this sort of larger question about what's the appropriate approach is, we're thrilled that data minimization is not only in the principles, but also, FDX's principles, or the Bureau's principles, but also FDX's principles. We'd actually like to see some hard rules in place that make clear what data minimization really means. And we think that's within the reasonable expectation of the consumer. So I'll give an example. I'm not going to name the company, but it is a financial service provider, is actually in their agreement, it says they can collect your health information. This is not an insurance provider. This is just because you have the app on your phone, they're going to collect whatever health information is tied up with your phone. That, to me, is well outside of reasonable consumer expectation, and it's very clear that shouldn't be. It's very clear, I think, that is a dangerous thing to have collected and shared. Consumer Reports has done recent work about how HIPAA doesn't apply to a lot of things. So, again, not unique even to financial services. One other component here is around this question of sort of what are the use cases? And I think there's a need for flexibility, right? That not every use case needs the same amount of information. And so that reasonable consumer expectation standard will be very different. But I do think it's very clear that permissioning for one purpose should not mean never-ending surveillance. And I think that's kind of another part. So consumers should have control, but the entire burden should not be on consumers to protect their privacy and data security through settings and controls.
Go ahead, or I'll move on to the next topic. We've discussed access, and of course, an issue that flows from that is which elements of the data stored at the financial institution should be accessed. So let me start with you, Becky, and ask, are there any elements that the FI can protect against even consumer-authorized access?
That's a good question. And just to build on Christina's point, I think right now, when you think about data minimization, you think about these attributes, the problem today with credentialed screen scraping is that they have access to all elements, and the consumer really doesn't have that control today. And so as you think about what should the consumer have access to and are there buckets of elements, I think we think about it as there's three buckets. The first one is the basic account transaction data that is needed to solve the majority of the use cases today in the ecosystem. Not all, but the majority of them. And I think that is easy to share. It's doesn't really provide there's not harm out there really for that data to be shared and used. There's another bucket of sensitive data, which includes PII. It does include account numbers, things that can be taken and used in fraud situations or to harm the consumer, which again, I think can be permissioned from the consumer, but with very clear transparency and with additional controls needed, whether it's additional consent that's needed or additional security that's needed on that data. Those are the things that need a lot more scrutiny, and they're not as simple as that first bucket. The third bucket, I think, is a bucket of what I'd call proprietary data that today we don't see a need in the industry to be shared. There are not use cases that have come about, and that they can be harmful both to the company itself and as well as the consumers. And I think that bucket is one that today can be accessed through screen scraping, and a lot of times without knowledge, and that's one that still needs to be explored more.
Can you talk about what the components of proprietary data would be? I can see different institutions
Yeah.
maybe using different definitions.
I think it is different for different institutions, and I think it's not just for financial institutions. I think everyone in the ecosystem has data that's proprietary to them, that's created and personalized or customized for their business through their own models, through their own insights. And so I think it is different, but I think in general, we create personalized and customized products for consumers that really are based on the proprietary methodology of our company, and that is information that belongs to the business itself versus the consumer.
Could you give me an example of what that might be?
There may be specific product terms or features and functions that exist for a given institution that they've created for that consumer within their business.
Great. Let me move down the line.
Yeah,
here to John.
I'm willing to volunteer what we've heard from an FI before as this is proprietary. We don't think the consumer should be able to share it, which is the rate or fee they're being charged on a product, right? Which they are disclosing to the consumer because they have to disclose it to the consumer. So the consumer can tell you, I am being charged $25 per overdraft, or I am being charged 19%. It's in fact in the CFPB principles that those are the types of things to which the consumer has the right to access. And yet we hear sometimes that that fee, because it was derived from a proprietary method, is itself proprietary and the consumer doesn't have the right to share it. I'm troubled by that as a definitional line. I agree with Becky that if there are things that are proprietary to the financial institution, including some specific terms, those are not the consumers. They don't have the right to access it. I would propose sort of a basic and I think consumer intuitive definition, which is if you've provided it to the bank or the FI, if you can see it when you log into your web interface, or if it's essential to the functioning of the account, because remember, this is ultimately account information, that is what you should have the right to access and share with a third party of your choice.
I think the only consideration to think about is, with a lot of those terms, when the consumer asks for it, it's given one-on-one. When it's given in the context of millions and millions of pieces of data in one place, it can also be viewed differently. And so I do think there's a distinction between the right for the consumer to directly have it and the right for the consumer to hand that to a party that's collecting it on a scale of millions and millions of elements of data across the U.S. or the world.
And I agree with that, but I think one of the benefits you have, right, is the ability of competition to drive down prices then. And there's a balance to strike, but I think you can't foreclose that ability to compete down rates and fees simply because there are other concerns that would come into place. Those are concerns that we should address separately while not limiting the consumer's access.
So is there, I know the example you mentioned was interest rates. Is there anybody on the panel who wants to advocate for interest rates being proprietary?
I think it depends on each FI and each product. I think there's different interest rates for different products, for different consumers, for different things, and it's not, I don't know that it's always a one or all. There are some fixed price products that are out there. There are some variable price products. Sometimes the value, so I don't think there's a generic answer, but I don't know if Natalie has a thought too.
No, I don't have any comment to it. I agree with Becky. I think it's complex. I think from PNC's position, our focus is on there's certain data elements that are sensitive, like the account number, that can lead to fraud or account takeover, as we've talked about. We've observed it. We've seen it. And again, customers' trust is with their bank. They expect that their bank's going to keep their money safe. And we take that role as data stewards very, very seriously. And so, the things that we think about when we think of data elements, we've already said it here, data minimization, the focus on use case development, and FDX. And what we mean by that, just to make that a little bit more real for folks, there's a broad data set that's necessary for personal financial management, right? And then for something like credit decisioning, that's a one-time use, where you might just need to verify your assets to apply for a mortgage. Yes, I have $30,000 in this account. That's a balance lookup and a verification that, yes, this applicant owns this account. Maybe 2 data elements. That credit decisioning use case shouldn't have the same amount of data access as the PFM need. So that's what we're talking about with data minimization, use case focus, not looking to restrict any use for the customer, but wanting to ensure that it's aligned to their interests and expectations. The other piece when we think of the sensitivity of data that will be improved is moving to the API and away from screen scraping. Again, that's going to enable the data minimization. And the final piece, Becky hit on this a little bit at the start, is, there are other ways in which to meet the needs of some of these data elements. In screen scraping, it was easy, everything was there, and some processes were built as a result of that. But something like the account number, do we want that to continue to be shared to the data aggregator, to the fintech downstream? And I know many of my friends up here agree that we want to try to restrict how much that has to be shared to facilitate money movement. And so a simple concept of tokenization, it's what we're doing today with credit cards. You're able to issue a token in place of the actual card number. That's being discussed as well, and I think a necessary step forward to give the customer more control over enabling money movement out of their account without having to give away the keys to it.
John, are there use cases where you think the account number should be shared?
I'll let Nick go first.
Yeah, so if you think about the way that the ACH system works today, and the idea of the account number and routing number, which is one of the core use cases of you should be commenting on this, but you think about the idea of delivering that data through an API with an OAuth experience. It's far more secure than that being printed on a check. And you think about how the ecosystem works today with, we talk about safety and soundness of that data, but the movement to a consumer permissioned access to their data, with that data being delivered electronically to somebody who is meeting the bar, which is where I started, is that there needs to be a bar met by those that are using that data. But the idea of hiding all the information so that can't be seen in the ecosystem or used the way that it's used today, it actually creates a dangerous, it's a dangerous tipping point, because the ACH ecosystem, for example, is all kinds of innovation has happened because of the availability of that account number and routing number. So the idea that information shouldn't be shared or it should be tokenized, I think, introduces additional innovation risk. So, let's think about where we are today. The fact that your account number and routing number is printed on every check and sitting in a checkbook in your drawer and stapled to some document that you provide your employer. The idea of the consumer permissioning that and that being delivered digitally, and standards being created around how those are used so that there's a level of responsibility for those using that data in the ecosystem. I think that is something that we have to be mindful of, and that's a better place than where we've been. And we don't want to risk shutting off innovation in the world of payments through the idea of trying to hide the account number and routing number as is being proposed.
I don't know that anyone's proposing to hide it. I think there are just ways to secure it. I think Natalie's example of tokens that can be used in the ecosystem, and I agree with you. I think the whole ecosystem has to move to a place to think about this in a more secure way. I also think that there's a big difference between a one-time use of an account number in transit for a payment versus account numbers sitting in the clear, millions of them sitting at an aggregator or a fintech or a third party. And I do want to distinguish that, because I don't know that anyone up here is saying we should hide them or not allow them. I think we're just saying we need to figure out a way to do it in a way that's secure and safe for everyone involved. No one up here, I think, wants to have an issue where account numbers are compromised in the clear on scale. So I just think that's really the push.
I agree.
Do you want to go, Natalie? I saw your.
I agree.
So just adding on to that, I mean, I think we all view this as an area where there can be improvement. I know that a lot of folks are working on tokenization. But again, I'll pull back to, this is something consumers are using right now. And the one thing I'll disagree with you a little bit on, Becky, is we have seen behavior where sort of there's an attempt to hide the account and routing number from the consumer or make the consumer have to go through extra hoops. For example, after having done a multi-factor authentication, do a separate one to see the account and routing number. And I mean, if we take this to the extreme, you can imagine a world in which, for example, every single digit of your account and routing number requires the consumer to enter another additional multi-factor authentication to see the next digit. I'm not sure that that adds a lot of additional security. I do know it adds a lot of additional friction, and that's why one of the things I'm happy about with this group, all of us being in FDX, is we're committed as part of our mission to making sure that consumer access is balanced with security, that is something that goes hand in hand. It's not an either or, it's a both together.
Go ahead, Christina.
So I want definitely agree around the security component. I do want to address what I like to call the friction fiction, because I feel like consumers actually do tolerate a great deal of friction, because what we've seen when we talk to people is that they have these insane workarounds for so-called securing their data, which might include, from their perspective, this being more secure is closing and reopening accounts, deleting payment credentials, like all sorts of things that indicate that although maybe what's considered traditional friction with two-factor authentication may have a drop-off, there may be other insane things that people are doing that are entirely reasonable given some of the so how few bumps of the road there may be, or at least consumers appreciate. That's one piece. The other component, I want to scroll back to a few minutes ago in this conversation around what elements consumers can permission. And, we definitely believe that it should be what's relevant for the purpose for which the consumer has sought out. And so one of the key components, and I just want to talk about interest rates, if the reason why interest rate is being collected is to better market to that consumer, that may not be relevant for the particular person, or it may be. And so, one hard, fast rule would not necessarily apply to all those use cases, but it is really critical that the data collection shouldn't only be about how best to market to people, and it really has to put the consumer focus around why are they there and what are they seeking.
For the next question, I'm curious in hearing each person's opinion on this question, starting with Nick. Is an FI's decision to ban screen scraping right now, is that decision in the best interest of consumers in your view?
So, I think we all agree that credentialed access to the financial data is not the best approach. But it has served us really well for 20 years. Now, there have been issues, and we have, as an industry, worked through some of those issues through the years. But generally speaking, consumers have spoken. They want access to their data, and screen scraping has been the only way that data has been made available. And I also want to clarify that screen scraping has been, there's basically authentication, authorization, and data access. Screen scraping is a method of getting the data. It's not necessarily the method of authentication and authorization. And so APIs is a way to deliver that data. Screen scraping is the idea of taking an HTML page and deconstructing the tables in HTML to get access to the data. So we need to make sure that we as an industry and as regulators and lawmakers understand that screen scraping is not evil. The use of credentials is something that we really want to get away from. We want to move to tokenized access. But there is a long tail of financial institutions, and it's going to take time for these API standards to proliferate. And so I think the first step that we need to really take is, how do we solve the problem of authentication and authorization? How do we get credentials out of the market? And two, how do we make sure that the data that we're getting is the best quality data delivered as quickly as possible? And I think we should break up the term screen scraping so that everyone understands that it's actually two different things: authentication, authorization, and data access. And so a near-term future where you fix the problem of authentication and authorization, but maybe screen scraping is the only way to actually get the data, that's not a bad place. And so I don't know if anyone else would comment on that, but screen scraping is an evil in its own right.
I think, and just to comment a little bit, I think and our written statement talks a bit about screen scraping for those that haven't read it yet. I think the challenge with screen scraping is that it's not allowing us to fulfill the principles that the CFPB put out to minimize data and to ensure that the customer understands and has control over what data they're sharing and for how long and for how often it's accessed. Often data aggregators are accessing their account multiple times a day, sometimes more than 10 times. Because we don't think customers understand that or see that. And so I think as it relates to screen scraping as a practice, it's, as I stated earlier, we need to see the end date. I think everybody here needs to focus on that, and it needs to happen as quickly as possible. One thing we haven't mentioned yet, it was announced last week, but PNC is one of the bank investors in Akoya, which we have done to help with the scalability, as Nick and John had both mentioned. It's challenging in the existing environment where we're negotiating one-on-one and bilateral agreements. We think the investment in Akoya will enable more of a central network that would make it easier and more efficient in connecting. When you consider the smaller banks, as well as smaller data aggregators or even fintechs directly, ideally, Akoya will be established to help facilitate quicker movement towards adoption of APIs.
I would challenge Nick a little bit on that. Maybe screen scraping isn't evil, but I think it is dangerous for consumers. And I want to call out that separating the credentials and the actual scraping itself, one, just kind of continuing to hit on, the consumers don't understand what screen scraping is. It may have been around a long time, but now the director mentioned with the proliferation of the number of aggregators and fintechs, people are starting to wake up a little bit to the fact that this is happening. They have no control over what's being taken. And these are, in all intents and purposes, bots coming in to do the HTML doing. And what happens with that is data accuracy is sometimes wrong. The web page changes, something changes, they pull the wrong data and it's inaccurate. Mistakes are made. That is full access to your account. We've seen instances where screen scraping has caused changes to accounts and mistakes to happen to accounts because there's not a lot of controls over it. So I do want to highlight that screen scraping itself, evil might be a strong word, but I think it's dangerous for consumers, and I think that it's dangerous for the ecosystem and the data going in that we have to consider.
Yeah, and our history at Finicity is we started in the direct-to-consumer space as a budgeting solution. And back in 2007, we were seeing problems with duplicate transactions when we were scraping the data. And because there was no transaction identifier tied to that transaction, it was problematic. And so we made a hard turn to go for formatted data sources. And so, we're authenticating using consumer credentials, but we're getting the data from formatted sources, and so 95% of our integrations do not use screen scraping, but we do use formatted sources behind the consumer login, and so the vision of the future is one where you have defined use cases that have defined data elements that are required if you want to interoperate for that particular use case. You have the ability to, go back to the bank and say, listen, I want to shut off my data flow to that app. And that not only do you revoke the token, but even, this is a Finicity vision, is that we see a future where the consumer has the ability to issue a right to be forgotten. So not only shutting off future access, but to be able to say, please erase my data. And so the idea of consumer control, this is an evolving marketplace, and the steps that we're taking as under FDX is really to create this vision of the future that all of us agree on. It's a matter of how long it's going to take us to get there, and I believe that we do share generally a common vision of that future as FDX is promoting.
So I'll jump in and just say, no one has thrown out numbers yet, and I do think numbers are useful here, right, in trying to understand this. Best count, and this is from FDX, so this is all of us roughly agreeing or making our best estimate, is 100 million consumers using at least one app. Between 50 and 100 million, I think 100 million is probably closer to the right number. And 8 million now using APIs versus credential-based access. So we are making progress, but we also need to be realistic about how much work is left to do. It's something we're all dedicated to, but Paul, to your original question, if someone turns things off right now, what's the consumer impact? Something close to 90% of consumers losing access to something that is essential to their financial lives. Pulling back from that a little bit, there are things that individual members of the ecosystem are doing right now to improve those controls that I think are incredibly pro-consumer. I mean, I think of the Wells Fargo control tower, which even in the absence of APIs is able to show consumers where their connections are and let them control those connections. Plaid's doing the same thing. We're building a consumer control panel so that consumers can easily depermission anything that they've attached to an account with a single click. And we're doing it because it's the right thing to do, but Becky, I'm interested in your thoughts on this also. It's also, we think, the necessary wave of the future, right? California has a consumer privacy law that applies to all of us. We apply it to consumers who are not just Californians, it's nationwide, right? Because it's what is going to be required. Although, Nick, I disagree with you. It's not necessarily what is going to be required. It's what is required today, right? And what a responsible business should be doing. So we're all doing this right now. I think one of the next challenges is going to be making sure that those controls are interoperable so that if, for example, a consumer wants to turn something off at Plaid, Cap 1 gets the message. If the consumer would prefer to do it at Cap 1 is able to send the message to Plaid, and the consumer doesn't have to go from app to app, bank to bank, aggregator to aggregator to issue a directive. They can issue it one place, and it propagates throughout the entire network that they're connected to.
I think that's the key, because while many people are using these fintech apps and other apps, I don't know that many people in this room know which aggregator is driving your fintech app that you're using today on their phone. And so I think it's really important that transparency has to exist, and it is required today through California and other things that exists everywhere.
Christina, if I can return to the original question about banning screen scraping now and whether that's in the interest of consumers, what's your view there?
So I'm going to chicken out on the answer and present the, I want to present sort of some of the controls that we would love to see consumers have spelled out a little bit more concretely, which is it's not just that providers are required to practice data minimization, but that consumers have the right to review and correct information regardless of use case. So, right, because it has implications even for budgeting if your information is wrong. The right to cut off secondary uses, right? So one of the things that we're seeing, and I made this reference earlier, right, of about the vagueness of privacy policies, is that we see a lot of policies that reserve the right to keep your de-identified information forever and share it forever and use it for any purpose. And there's mounting evidence that de-identification doesn't always work. And so we have a lot of concerns about this idea that your information is sort of infinitely available for any use. And then the right to revoke access has already been talked about, and then the right to have information deleted. So we think that regardless of what the technological solutions are, and we are completely agnostic in that area, that those fundamental rights should be there because privacy is a fundamental right, and it needs some clear spelling out because sort of anything goes right now.
Very good. The last topic I wanted to discuss is technical standards. We have just a few minutes left before our panel ends at 10:40. Natalie, I'll start with you, and I'll let folks be a little bit more open-ended if you want to address something that I haven't raised or that you want to communicate in your concluding remarks here. But my question is on the development of technical standards for data sharing, primarily through the APIs. There are certainly benefits to uniform standards. On the other hand, is there a potential that we might lock out future innovation by prescribing that data can be shared only in this manner?
Yeah, I think we've mentioned FDX a couple of times now. The Financial Data Exchange is an industry group that was formed a little over a year ago. We're all members of it. Several of us sit on the board as well. But it's made up of financial institutions, data aggregators, and permission parties, those entities that would receive the data, perhaps through from a data aggregator. And that body was stood up to serve as the standards body for the actual API that's used. So it's, and what we're saying is the spec itself, it's called the FDX API, it's that the way that the data is formatted, so it's consistent across every FI, every aggregator, every fintech. They're accessing the data. They know how the data should be mapped, so there's no more confusion on is this the available balance, is this not? So so we think that PNC, at least I think, I've enjoyed participating actively in our conversations. I think it's a great forum where we're able to talk about some of these concerns and ensure that as a standards body, we're considering and have open forums to discuss any changes that might be needed to ensure that there is no blocking of future capabilities. I think the other piece that Nick spoke about it a bit as well, but the other piece that FDX is hitting on is the customer consent process. We're conducting user testing and working together to ensure that permissioning data at PNC doesn't look or feel drastically different from other FIs. And so, again, related to that, we haven't really touched on this, but, giving customer control when they do go to establish that connection. I spoke a little bit earlier about today the consents are done either through the data aggregator screen or they're really started at the fintech, and the customer's unsure. Am I at my bank? The screen sort of looks like my bank, but what's happening here? And so in the future, when we do move to API data sharing and more of a tokenized access model, we feel strongly that the customer should be redirected to the bank to authenticate, to log in. The customer has control to then view and select what accounts do they want to share with this application, and for how long. And are there specific data elements that are requested, and have an opportunity to really understand and learn more about the type of data that's being shared, et cetera. So we do think that's really important at setup. And then for ongoing management, it was referenced, Wells Fargo's solution. Many FIs have a similar tool. We do as well at PNC, where once the data is being shared through this avenue, the customer would then be able to come in to PNC and say, oh, okay, that's right, I permissioned that app, I've never used it, I'm going to shut it down. Because again, just deleting the app doesn't stop the access to the data, and we need to give consumers more control and be transparent about what that means. So we're all for, ensuring that we have the ability to give the customer that information, and intend to encourage and increase awareness of, hey, do you remember this one? Are you still using it? That sort of thing. So we're looking forward to that day.
So, the other side of standards is that we talk about the ability to create this ecosystem, and the only way that we can proliferate this amongst, the long tail of financial institutions in the U.S. is through standards. And so having common API standards, having the ability to certify to that standard, and having solution providers to small to medium tier banks who can take a standardized offering and then light up the rest of the industry, that's one of the benefits of standards as well. as an aggregator, as both, signing data access agreements and signing commercial agreements with financial institutions, we have to undergo audits, security audits over and over and over again. And the overlap between those audits is significant. And yet everyone, comes in and says, well, that's great that you passed with Chase, but we have our own special sauce. And so the idea of being able to standardize even security auditing, InfoSec audits and the like, will reduce cost in the industry for both financial institutions as well as for data aggregators and permissioned parties. And so I think just as we've seen with PCI in that standard and how credit card data is used, the idea of having common InfoSec standards is also a great move forward for the industry. So, Finicity, we've led the charge with signing data access agreements with FIs. Nearly, half of our traffic by the end of this year will be flowing through tokenized access to financial institutions. We've signed more bilateral agreements than anybody. And we believe that the future is coming very quickly. But in order for us to really hit the small to medium tier financial institutions, standards need to exist, both from an InfoSec and from an API standard, so that can be easily stood up by these other players.
Well, thank you very much, Nick. Unfortunately, that is all the time that we have. Please join me in thanking our panelists.
Well, that was great. Thanks again to Paul and all our panelists. We're going to take a brief 10-minute break, so please be sure to be back by 10 till 11. Thank you. Hi, folks. I'm just going to give everyone kind of a 2-minute warning here. So if you want to wrap up and begin making your way back to your seats, we want to stay on track.
Hello, hello, hello. Hello, hello.
Hi, folks. We're going to get started. If everyone can migrate back to their seats. I'd like to do my best. I'd like to go ahead and invite our panel up.
There's one.
Yep. Hi, folks. We want to go ahead and get our panelists up, please. All right, great. So we're ready to begin our second panel, and with that, Will, take it away.
Andrew, thanks very much. Good morning, everybody. Welcome back. I will introduce the panelists as we get settled here. All of the panelists that we have here today are widely known for their expertise in this area. Our focus here on panel 2 is on market developments, market trends. Everyone here is a close market observer in the data aggregation space. In some cases, they are market participants as well. We are grateful to have them all. I would also commend their written statements to you, which have been posted on our website. My focus was on the panel 2 written statements, although I did read everybody's, but I thought in particular the panel 2 statements were models of clarity and directness, and I would commend them to you. let me introduce our panel. Sitting next to me, Steve Baums, number of roles. I think it's fair to say you're here today with your F-Data hat on. F-Data is an association with global reach that seeks to advocate for consumer permission third-party access to financial records. Steve is the executive director of F-Data North America, which was founded in early 2018, and I think it is some mark of the pace of evolution in this space that makes it one of the older organizations active in this space in the U.S. Moving on, Kelly Cochran. I know you. Kelly is the deputy director at FinReg Lab. She and Melissa Coide, who I think is here today as well, who's the CEO and director of FinReg Lab, and other colleagues there have been active with their research partners in looking at cash flow underwriting. They put out a number of extremely interesting reports there. And their latest, thanks Kelly, came out this morning. It focuses, at least in part, on market and policy analysis of data aggregation in the context of cash flow underwriting, and we're certainly going to talk about that study here today. Prior to her role in at FinReg Lab, Kelly had 1 or 2 jobs in government. I can tell you, when she had those jobs, she had a reputation for sending emails at 2 in the morning, so the timing of the release today came as no surprise. There you go, there you go. Moving on down, we have Leela Fakre, who is from Wells Fargo, where she has had a variety of senior roles. Currently, she is the senior vice president for digital banking and APIs. Or is that digital banking APIs or digital banking and? There's an and, okay. She's also one of the co-chairs of FDX, about which we heard plenty on the first panel. That launched formally in 2018 as well, and which, among other things, promotes the FDX API standard. Many of our panelists here today and in other panels are members of FDX. Moving on down, who do we have? We have Jason. Jason is the co-founder and CEO of Petal, which uses cash flow-based underwriting to support the issuance of credit cards. Petal is thus in the direct business of securing consumer permission to access checking account data. We're glad to have that fintech user perspective here today. Jason also serves on the Bureau's Consumer Advisory Board. Finally, Jim Ryder. Jim is the president and CEO of First Bank, based in Lakewood, Colorado. He and his bank have been active in this area for a while. First Bank is also a member of FDX, one of the smaller bank members, I think it is fair to say. Jim is also a board member at the ABA, where he helped them to develop their set of principles for the aggregation space. Despite those various affiliations, having met Jim and talked to others who know him, I can assure you that he is very much his own thinker on these issues. So, with that intro, let me kick it off. I'll start with you, Steve, if that's okay. So your written submission for F-Data North America calls for the Bureau to have to issue a particular rule in relation to 1033. Now, our focus on this panel is not regulatory interventions per se. That's more of a focus of the next panel. But I want to talk about the market underpinning for that recommendation that you made. And in particular, you wrote that the Bureau should issue a rule that would provide U.S. account holders with the right to access and make portable any element of their financial data that would be available to them through their FI's native online banking app and paper statement. So my question is, how far are we, in current market terms, from consumers having that ability in practice?
Thanks, Will. I might start by giving a bit of a global perspective and then providing some data that demonstrates we're not there yet, which is why our view is that that's a role the Bureau should play under its 1033 authority. Well, as you mentioned, F-Data is active globally. We have our roots in the UK and Europe under PSD2 and open banking. We are active in Australia. We're active in Canada. All territories or countries where there are open finance rules. And the reason I call them rules is because each of them, the basis of them is some type of government intervention in the market that made clear requirements that there is a legal right for consumers to access their financial data. And in fact, in the European and UK contexts, and obviously in Australia, those requirements go beyond just financial data. It's going to be in Europe and the UK and will be in Australia, data more generally. We're not there yet in the US, and we're not there for a number of reasons. One of the reasons is, as you heard in the previous panel, ambiguity over what is proprietary data. that a financial institution holds. Our view, obviously, is fees or interest rates is a fundamental data field that is required for consumers to compare providers or services to one another, and is part of the underpinning of a healthy competitive marketplace. And we've done some data polling on this to kind of highlight why we don't think we're there yet. And there's two elements of this. One is connectivity data. So how successful are you as a consumer today if you seek to connect a third-party account to your bank? The other is data field availability, particularly if we move just to APIs, which gets to the conversation on the previous panel about scraping versus APIs. On connectivity data, what we found was, and we broke this out by different kinds of financial institutions, so the largest, some of the smaller, neobanks, et cetera, et cetera. Depending on where you bank, you are somewhere between 40 and 48% likely to not be able to connect today your third-party account to your bank, which means that you can't use that tool.
You, the consumer.
You, the consumer. And that tool may be an underwriting tool, it may be an automated savings tool, it may be a robo-advice tool, across the gamut. On the other end, we did an analysis and said, okay, well, what if we turned off screen scraping and moved just to APIs today, overnight? And our analysis found that just among our F-data aggregators, 1.8 billion, it's billion with a B, consumer accounts would lose access to at least one data field critical to fueling the use case they use today. Obviously, that doesn't mean 1.8 billion Americans would lose access to tools. We don't have 1.8 billion Americans. We can't tell you exactly how many people that means because we don't have access to the PII, but it's safe to say that's tens of millions of Americans who would lose access overnight. So the reason why we call for that rulemaking under 1033 is we're not there yet, and we fundamentally don't believe the market itself can get us there, given the ambiguity in the marketplace.
Okay. I noticed also that data you had different rates of connectivity for recurring access. Could you talk a little bit about that? I saw some interesting variations too there.
Yeah, sure. Yeah. So on recurring, what we said first was how successful will you be in connecting your account in the first place? Recurring says, okay, so if you were one of the, I'm doing some quick math in my head, 60 to 52% of people who were successful, how likely are you to be able to continue to get data from that connection to continue fueling the use case that you're using? So think in the simplest terms, a personal financial management use case, like a mint.com, just as the easiest, where every so often, and we said once a week as our baseline, that data needs to be refreshed in order for that use case to actually provide you with the benefit that you've signed up for. And we use the same different categories of banks. And what we found was a fairly high degree of success at some banks. At the highest, it was about 94.5% of recurring connectivity success. But the farther down the long tail of financial institutions you get, and this probably is not a huge surprise, that number decreases significantly to, at its peak, about 20% of failed connectivity on a recurring basis.
So I'm going to ask one more question, and then I'm going to ask Leela to respond to what you've been saying, but just I think it's important for people to understand. Thank you. Focusing not on the 1.8 billion for a second, although that's obviously a striking number, but on the roughly 50% initial connectivity rate and then those other varying rates depending on size of recurring connectivity. Why do you think that is? What explains that?
There are any number of reasons, right? And so part of this is conjecture, but part of this is based on evidence. Part of it is just technologically, it's difficult to maintain these connections. And so in some cases, the connections themselves just aren't built technically well. In other cases, the imposition of multi-factor authentication and the time that it takes for the consumer to get through that process. So for example, if the text message that you get with your one-time code takes not 10 seconds to arrive, but takes 2 minutes to arrive, how likely are you to be sitting in front of your phone waiting for that text message and still have that app open versus just walking away and not using it? There are instances where financial institutions are restricting access to some of these use cases or to these aggregators, in some cases. So it's a mix of different elements that all add to a pretty high rate of failure.
Thanks, Steve. Leela, can I ask you to respond to that? In particular, if you can cover, I mean, range widely, as widely as you want to go, but I'd be interested in your perspective on that connectivity data itself, whether that strikes you as right or not right, and in particular whether there are trends that you see that might change that picture in the future, and the same with respect to the data fields. But don't limit yourself to those two. Go as broadly as you want.
Okay. First of all, thank you for having us here. It's really great to be here. So, you know, I think when we talk about connectivity, it's really important to kind of divide the various elements into the current solutions, which is our current screen scraping and credential sharing model versus the API model, right? And I think the references that were just made by Steve are all about the current existing model, right? And we know that that's moving away and we're moving to the future. So there's so many so many things that are fraught with the current model, whether it is the brittle nature of screen scraping, where things break all the time, scripts break all the time. You know, if the bank decides to change something on their, whether a security enhancement or a change to their user interface, that will definitely break the solution. And then the other thing is, you know, the screen scrap, I mean, everyone said this on the first panel, in terms of transparency or traceability, customers don't have very little control over what is being shared and how much visibility they have to those things that are being shared. So I think it's kind of a fundamental model thinking shift. I can talk about all the things that are fraught or wrong with screen scraping, but I think, we've moved on so much in terms of this conversation, whether it's our FDX API or all the banks that are offering a solution and offering a channel to provide data, customer data. It is, I think, better to kind of talk about what are the things that we can benefit from if we were to move to the API, right? So it gives us customer control. It gives the customers a lot more control over what they're able to see. The first panel, folks talked about, the list of accounts that they're able to share. Or, in the future, within FDX, the development of use cases and being able to talk about not only the minimization of data and the data elements that are required for that specific use case, but also the length of time that you're able to share it, right? So the challenge, I think, is many times, like the particular use case, take a lending application, you don't need indefinite access to data. You apply for a loan and then you're done. And do you want that entity to be getting your data regularly, ongoingly, because they have your credentials already and they will sign in on your behalf, maybe 4 or 5 times a day? So, I think those are kind of the fundamental issues to be addressed, as opposed to the current access is brittle. I understand there are issues with it. Then the numbers in my head don't add up. We heard, I think it was John that mentioned the FDX data collection. So what I've heard of in terms of what we have been able to get our hands on in the in FDX, in terms of how many customers have shared their username and password with the various apps, is somewhere between 50 and 100 million customers. The key point on that, though, to remember is these are the ones that they have ever shared their apps, their username and password. Do they keep using those apps, or did they delete it after a few days? There's another study done in terms of number of customers that actually delete the app within 30 days. It's somewhere around 93%. So only 7% of customers keep coming back to that app over and over again. And so, I think it's important to get our numbers right. We don't have all the parameters built yet and all the numbers right, but I think it's hard, it's convoluting issues if you talk about the current model and how it's restricting access versus the future model and how it's opening up access.
So your view is, if we take the clock forward a couple of years and we look back, you think with the moves, and I think Nick helpfully separated these things for us, sort of the move to APIs and then the move to tokenized authentication and authorization, you think we're going to see the solution to the problem that Steve identified?
I think we're going to definitely see a big improvement in customer control and transparency. I think we still need to figure out, within FDX and other places and forums that we are all present, what are those elements that we all still need to agree on? And, FTX is a great place. I heard Natalie talk about it. Essentially, a group of people who have come together to build interoperable standards around the API, but it's broader than that. It's a framework around user interface, around accessibility, around the certification, who gets access to data. So all of those things are important and difficult conversations, but we have all the right people there. If it's an ecosystem of aggregators, permission party, industry groups. We have several industry groups, and then obviously banks. So it is a place to have those discussions and conversations, but it's definitely not solved yet, but it's happening. It's in process.
Jim, please.
Steve, one thing I'd like to weigh in that you talked about is the long tail. There is a long tail, and a big part of that are the core providers for small and medium-sized banks. They have multiple cores, and so it's going to take us a while to get there, but screen scraping is not the way we want to do business. The friction, Christina said it earlier, and you mentioned two-factor authentication. It's one of the things strongly encouraged by the regulators, and we use it frequently when we see activity that's suspicious. And one of the things we face today are credential stuffing attacks. And they look a lot like screen scrapers coming in because they're machine-generated logins. So it just shows you that screen scraping is very brittle, and we need to get to the API standards. And it's going to take a while with the core providers and different things for small and medium banks. But we're on the journey. We'll get there.
Just if I could very quickly respond. So I wasn't trying to suggest that multi-factor authentication is bad. Obviously, it's very good and can protect consumers. I was suggesting, though, that the imposition of multi-factor authentication that takes a long time to go through the process can exert barriers to consumers accessing these tools. And the other thing, Leila, that I would say is the data that we collected isn't the old state, it's the current state. It includes the number I heard on the previous panel was the 8 million or so consumers who are accessing through APIs today. We are in the process of getting this data broken down on a go-forward basis, API versus scraping. The initial data that we've seen is unquestionably better on the API side. It's still not near 100%. And I don't know that 100% is the right place that we're ever going to get to, but it's still 35 to 40% failure.
Thanks for that. I actually have a question now for Jim that I didn't have until I listened to panel one, so thank you, panel one. Again, back to the distinction that Nick drew between actual data sharing mechanisms and authentication and authorization methods. You talked about the long tail, Jim. Obviously, APIs are expensive to build. You've got a lot of experience in this space, in the smaller bank space. Does Nick's distinction point to a way to bring the tail in quicker than going all the way to APIs? Could you go to tokenized authentication and continue to use the screen scraping method and then ultimately go all the way to APIs? Is there a possibility of a two-phase incorporation of the long tail? I mean, I think a lot of us have been sitting here wondering, when do the core processors make a move? I think I'd been thinking, when is that about offering API functionality, but maybe it's about something different first.
Yeah, I don't think that interim step makes sense. And the reason I do not think that makes sense is, again, if you put the consumer first, which is, we're a consumer retail bank, we're in the business of trust. And so when you enable screen scraping, even if it's tokenized, you're letting someone come in and get whatever data they would like from our customer. And while we want to enable them better managing their money, doing different things, we want to make sure they know exactly what they're sharing, with who, how it's being shared downstream. And screen scraping does not give us that kind of control. And so that's why I think we need to go to the APIs and have agreements with the aggregators and other folks we're working with.
Any different perspectives on that, or?
I think I'll weigh in a little bit. I think it's one of the questions that we've been thinking about as we've been working on this report. Our report is really focused on uses of cash flow data and credit underwriting, so it's only one of the use cases we're talking about here, not all of the others. And I think each of the use cases is a little different. But one of the things that's really struck us as we've looked at the data flow questions is there is this this desire to solve for everything at once, to solve all the liability questions and minimization at the same time that you're solving for access. it's really understandable, especially, I think, from a bank perspective, because, the potential liability and the concern about eroding consumer trust is a real question that is legitimate and serious for banks. And yet, at the same time, I do find myself wondering sometimes, are we making the perfect the enemy of the good here? I think it's a really difficult question, and it's one that we keep asking as we go through the process, because there are trade-offs, and it makes it more complicated to try and solve for all the things at once. We've seen reports that APIs can be upwards of $500,000 to build. That sounds high to us. Our sense is that might be an all-in cost as opposed to just the technology cost, but it is difficult, especially for small institutions. And so, I think continuing to ask that question and really probe is important, because authentication and APIs can work together, and they can work separately. You just have to make a lot of decision choices about doing that, and there are trade-offs.
So
If I could jump in quickly.
Yeah, Jason, I saw you trying to jump in, so I'm going to give you the chance first, and then I'll come to you, Leila.
Thanks, I appreciate it. I'll keep it short. First of all, I think that Nick on the first panel did a really good job of making the distinction between screen scraping and authentication. I think that there are kind of different pieces of this value chain. There are different things going on, and we tend to conflate consumer credentialized access with screen scraping, when indeed they are two different things. So I think, and we're members of FDX now as well. So I think that at least there's a lot of folks coming around the table to try to come up with common technical standards here. I think that everyone sees the clear consumer interest in limiting the number of parties that have access to credentials. So tokenization seems to be a good solution that everyone's kind of everyone's settling on. When it comes to the method by which you actually get the data, which is the part that is actually screen scraping, just to talk about that quickly, because there's been a lot of conversation about control and about the extent of consumer consent here and so on. I think that there was the screen scraping is not evil, and the friction fiction. These are kind of punchy slogans, but let's talk about what's actually happening here. So what we mean by screen scraping is that we use technology to take a snapshot of what the consumer sees when they log in. It's effectively the same thing as a consumer logging into their online banking, printing out their bank statements, putting those in a shoebox, and walking them over to their chosen financial provider. So there have been a number of questions raised about, well, what data should the consumer have access to, from a number of the panelists that represent financial institutions. And I would say that those institutions have already weighed in on that question in the information that they make available to the consumer on their online banking portal. And when it comes to consent, just very quickly, because these two topics are very much kind of joined, we have a system that allows consumers to contract with financial institutions for a variety of different products and services. Those contractual agreements can be entered into, both with a paper contract and a signature, and can also be entered into electronically with e-sign, so on and so forth. We live in the world of one-click mortgages, right? Push button, get mortgage, where people are agreeing to, dozens, if not hundreds of pages of contractual agreements binding them for 30 years based on just pushing a button. What we're talking about here involves the consumer taking the time to log into their bank account, which means you could be tapping through all the disclosures and the click wrap and all those sorts of things, and then you have to stop. You have to remember your banking username and password. And what is the consumer expecting when they do that? The consumer expects to see the information that they're always presented with when they enter their username and password. And if they're doing that in the environment of a new provider, their expectation is that they're giving that information to the provider, irrespective of what the terms and conditions say.
I saw both our bankers on the panel scribbling furiously, so I want to give them a chance to respond to that.
Yeah, well, I understand the desire to evolve and get there rather than be revolutionary and do this the right way technologically, but I find it ironic that we're looking to use screen scraping to facilitate data flows when we can do something much more sophisticated, much more permission. You know, Jason, you said basically be able to see what the consumer sees. There's a big difference in the consumer seeing their own information than us shipping it off and letting someone else see their information in ways that maybe they didn't really anticipate it would be used. And so I think that, you know, when you use that analogy, I agree, it's the same thing they see, but that's their own private data. Just like earlier, Nick was talking about innovating around the account number and route transit and different things. I sit there and go, the check is 50-plus years old. It's not a secure piece of technology. It's not a dynamic piece of data, the account number. And so for us, again, to build technology around that in this aggregation space, it just doesn't make sense to me. I think we owe our consumers more. They're going to expect that we are doing a better job than screen scraping and using 50-plus-year-old payment technology.
And very, very quickly, I'm fully in favor of these technological advancements, absolutely. Screen scraping is the interim step that was developed in a world where the institutions did not make the data available themselves. It's the only way to get access to the information absent actual technical integrations.
Leila.
Yeah, so I agree that screen scraping was necessary at the time it came about. It is no longer necessary, right? So for the most part, many of them large major banks have either moved to the API solution and tokenized exchange of credentials, or they're moving in that direction. And then to the I originally wanted to respond to Jim on the fact that the long tail and the smaller banks don't have the facility or the resources to build their own APIs. So another plug for the Akoya deal that just got announced. You know, Akoya is kind of a network of APIs. So, you know, getting data from point A to point B, it actually is the best way for smaller banks and the long tail to be able to get data, whether from large banks or from other fintechs. And so I think, you know, the idea that Akoya is built on APIs and it does not use screen scraping is a very key aspect of it. And that's one of the reasons all the banks have agreed to invest and expand on it. I think the adaptability, the growth and you know, being able to adopt more and more financial institutions in that direction is one of the key aspects of Akoya.
Thanks very much for that. Kelly, I've been meaning to ask you about your study. So let me get to that now. Three-part question. Why is cash flow underwriting such an important use case for permission data? And then I'm also curious about the methodology behind the report, the analysis that you do, where is the information coming from? And then focusing down on the data access component of the report, I think I'm quoting you here, you see some positive market developments and then some areas of uncertainty. And if you can talk a little bit about that, that would be great. And if any of the people you talk to have a perspective on the Akoya deal, maybe that wasn't announced in time for you to have a perspective on, I don't know, but.
Sure. So as I said, we started this project more than a year ago looking specifically at the use of cash flow data in credit underwriting. And we're really talking about a little more complicated use than I think other folks have mentioned so far. So this is not just a question of maybe authenticating assets, but really using the data that you can learn about how a consumer or small business manages their finances in the credit underwriting process in the same kind of way that you might use a credit score or traditional data that's coming from a credit bureau. So it's a deeper use. It can be just verification, but we were actually really focusing on using it in the underwriting process to make decisions. And it's not necessarily just one time, particularly when you have an open-end credit product like a credit card, you're going to be underwriting over time as conditions change and the consumer's situation changes. So these are not all one-time uses, and so that's another consideration to take into account. The first part of our project was looking at data variables that are being used in the market today by a number of different providers, including Petal, and comparing how those data work and their predictiveness in actual loan performance as compared to traditional credit bureau attributes and scores and whatever information we could get from the individual companies. What we found was it was very predictive, that it seems to be showing not just that it's about as predictive as some of the credit bureau attributes by itself, but that it also added value when you combine the two frequently. And so it seems to be showing some insights that are a little bit different than what you get out of a traditional credit score. So it potentially is valuable not just in underwriting people who are outside the traditional credit system, who don't have enough traditional payments history to be underwritten using a traditional score, but potentially even people who do have scores, who may have thin files or even thick files, to have a better understanding within a particular score band of which of those consumers or small businesses are likely to repay or not. So that's tremendously powerful, and I think it shows why this data that we're talking about is potentially so important, because it's talking about increasing access to credit, really helping both the consumers and small businesses and the firms do a better job in terms of predicting risk and managing changing circumstances and so on. So that was the first part of our project. Since then, we've done 2 reports. One is focusing on the small business market in particular and how the growth of electronic data is being used there. It's attracting new entrants into the market in terms of new lenders. And some of the reasons why it's particularly valuable in working with small businesses, because they've always been particularly hard to underwrite. There's not as much automation in that market, and so it's particularly valuable there. And then this third report, which we've released an overview document today, and we'll have a longer version with more footnotes for the lawyers in a couple of days.
Exciting.
Yeah, I like it, but there's 2 parts to it. One is a market context, where we're doing the same kind of deep market look at both the consumer market and then the data transfer market that is supporting this activity. And then the second half is really starting to turn to the policy questions and analysis and say, what does it take for this to reach scale? What are the potential challenges? What are the potential risks to borrowers and to firms? And so that was a long intro. In terms of the methodology, this part of our work is really based on a lot of stakeholder work. FinReg Lab convened policy working groups that had about 80 participants from all over the ecosystem, kind of all types of players, advocates, industry, different subgroups within industry, academics, broad range. We held a data symposium with the Federal Reserve Board of San Francisco last fall that was focusing particularly on the ecosystem and the data transfer piece. And then we've done dozens of individual interviews with folks and a lot of people in this room. So we thank all of you for your participation and input. In terms of what we're seeing in the market, there are a number of good things, and I think a lot of them have been touched on so far. You know, that there is this migration towards better technology that is more efficient and has a lot of different advantages to it. Some of the dashboards and other tools that people are being able to build on top of the API technology so that consumers are not just making a one-time decision, but are able to actually see their data and make decisions about it over time are also really valuable. So there are a number of positive things happening. At the same time, it's painful. Right now, a lot of this work is being done by bilateral agreements, one company or 2 companies on either side at a time. And what we're seeing is it's a network, but it's not exactly like a payments network or the traditional credit reporting network in terms of the roles of the entities in between. And so it makes it more challenging, I think, because there are a lot of really legitimate policy concerns and consumer protection and customer protection concerns. And there's a lot of competitive interests here. And it's very hard to tell where one stops and the other starts sometimes. Sure. And it makes it more challenging for people to negotiate through things altogether. One thing, I think we've touched on a lot of things. One thing that I'll say in terms of the use cases, for credit, some of the things that are particularly challenging, accuracy. Accuracy is important, obviously, for other use cases as well, but it's really important when you're making credit decisions. And the Fair Credit Reporting Act was built to manage that process in the traditional credit system. A big question here is whether it applies to this new ecosystem or not.
Right.
So accuracy, security, I think we've already talked about. The transparency, and not just the one-time decision, but the ongoing over the life of the relationship, over the life of the credit relationship, particularly in cases where lenders may be accessing information more than once, how that works in the servicing and collections process as well. And then finally, how does that data get used for other purposes, and what are the boundaries around that? Gramm-Leach-Bliley Act is broadly applicable to financial institutions, but there are some complications about how it applies, and we continue to hear people say that they feel like that's an area where additional guidance would be helpful to make sure that everyone in the ecosystem understands how those different pieces work and how it applies to them.
Thanks for that. Let's talk to somebody who uses cash flow underwriting in the market. Jason, practical realities that you confront. What market trends sort of give you optimism for doing what you're trying to do? What give you concern?
Sure, and
what do you think is at stake for consumers?
Yeah, right. So maybe I'll start by sharing just a little bit about our actual activities in the marketplace, our learnings, what we're experiencing, and what we do. For those in the audience that are less familiar with Petal, I was going to say that we're the youngest institution on the stage here, but I suppose F-Data North America chapter would take that specific title. So we use bank account transaction information in our underwriting process to facilitate the issuance of consumer credit card products. I often like to characterize us as sort of an outgrowth of research that was done right here at the CFPB. We started working on this issue a number of years ago at the time that the regulators were putting out really in-depth and groundbreaking information about the contours of credit access in the United States, sort of coining the term credit invisible as it's popularly used today, identifying 45 million adult consumers that do not have credit scores, to go along with the tens of millions of other consumers that have what we call thin credit files. Altogether, we're talking about nearly 100 million U.S. consumers that have a thin credit record or have no credit information at all, and as a result are cut out of the mainstream system. We also see that there are demographic disparities here. So if you look at the consumers that are credit invisible, they're disproportionately likely to belong to a minority group. They're disproportionately likely to be low and moderate income. They're disproportionately young. We also see military veterans that often find themselves in this circumstance. If you've been stationed abroad or living on a military base, you might not be building credit. We see older consumers that have not borrowed money in 7 years. They've paid off their mortgage, for instance, and all of a sudden they have the need to make use of a loan product, and they find that they have to start over, even if they've built a financial history over the last 30 years. And so you see how there are really significant gaps in what we are able to do using just traditional data as a mainstream system. And so at Petal, we began looking to other forms of financial data to fill in these gaps, to take a thin file and make it a full file, and to be able to expand mainstream access to these consumers. So our product is notable in that it is a safe and affordable credit product, typically with a far lower interest rate than other products that our customers would otherwise use. We are often able to extend more credit, and we do so without charging any fees at all. We also have identified that this particular customer base may be new to credit, may be financially inexperienced. And so we've built a digital product that is tailored to meet their needs, built in budgeting, credit score management, financial education, so on and so forth. Today, the overwhelming majority of our customers had thin or no credit information at the time that they were approved to use our product. And we were able to approve them for this superior credit product because of access to the consumer's digital bank statements, essentially, in a cash flow-based underwriting process. We believe that this solution can be expanded to tens of millions of people in the United States in the coming years. But that future is at eminent risk. The numbers that Steve shared in his written comment, and then again today on the panel, are consistent with our experience in the market today. We see a daily interruption of our business because of the lack of reliable access, to the extent that it threatens the viability of us and others that would use this technology to expand access and lower costs for consumers. When we pull the data, we see between 40 and 60% of attempts to link a bank account that fail on our system. And what that means is those customers are turned away, or it means that we underwrite those customers without a full view of their financial picture, and perhaps we're not able to approve them as a result. Perhaps they're charged a higher APR as a result of that. It's not just connections that fail at the first attempt. There's also wide variability in the amount of data that's returned. So in some cases, customers are able to leverage their bank statements going back 12 months or 24 months. We see that often from larger institutions, API-based connections, et cetera. In a lot of cases, customers are only able to provide 3 months of information. And so the certainty that that provides in the underwriting process is sufficiently diminished, such that two customers will not be treated the same way simply because they have varying degrees of access to their own information. We also see variability in account ownership information. So, if a consumer prints out their bank statement, it has their name and address on there, and so you know that they didn't take someone else's bank statement and walk it into the bank. It's really important that the data is identified to belong to that actual consumer. We see variability there as well. And so, as we prove the efficacy of cash flow-based underwriting, and as this becomes more and more a part of the mainstream credit process, we will see that consumers that happen to bank at institutions that participate in the open finance ecosystem will have greater access, will be charged lower prices, et cetera, than consumers who do not. And I don't think that that's an outcome that anyone wants to see.
Jim.
Yeah, well, first I'd like to make it clear, as a bank, we support what you're doing, Jason. We think it's great. We've wanted to issue more cards to thin file. We don't have your technology. I complimented you for being an entrepreneur because we need entrepreneurs. But the thing is, we want to do it right because I think consumers expect that. You talked about 3 months of statement data versus a year. That isn't a decision an institution makes, but they probably have another way to go get that data that's not as elegant for you to screen scrape. But the reason we want permissioned access, though, and consumer knowing what's happening, you said something that gives me pause, and that is looking at ownership of the account, look at the name and address on the statement, and you're determining they own that account. I can tell you it's much more complicated than that behind the scenes. There could be guarantors, there could be other signers that don't appear in the name and address. So again, pointing to the flaw of using screen scraping is you're making leaps with that data that don't even align with really what the consumer wants you to do. So that's my concern.
Steve, can I come to you? We talked about the cash flow use case. F-Data obviously has a global perspective, has played a large role in the evolution of these debates in the UK and other places. What trends do you see around other use cases in the US, and what ways can those be informed by what you've learned overseas? Are there things happening in other markets with permission data that aren't happening here, and if so, why would that be?
Sure. So I think the biggest differentiator in other markets is this concept is less about data access, or it's less couched in data access in other markets than it is about data portability or account portability. The notion that I can plug and play and take my account from one provider to another, be that a traditional financial institution to another traditional financial institution, or to a fintech or a neobank or some other provider. Whereas here, typically, we're talking about augmenting my base banking service or financial institution service with some other provider that's providing a very kind of narrow service to me that I'm opting into. in terms of use cases, as it probably wouldn't be expected, we see them across the board in other markets. So those are payment initiation use cases. There are insurance use cases. There are just basic personal financial management use cases, credit underwriting. But I guess to the broader point, we've spent a lot of time today on this panel and the panel before talking about technology. So screen scraping, tokens, credentials, APIs, and that's a critical element of this. But I think we're doing a disservice to the concept or to the notion of consumer data access if we're just looking at it as technology. I think the fundamental question is, be it through an API, be it through screen scraping, be it through credential access or token access, what data do you as the account holder at a financial institution have the right to provide to a third party? What are the governance terms of your doing that? What are the protections that you have? And the way that that's being done in the US, which is different than it's being done in most other markets, is through the formulation of bilateral data access agreements, which we've heard about today. I would argue that is a necessary interim step. There's no other way that we can get to the API world that we've all been talking about in the absence of those today. But that's also a suboptimal, to say the least, consumer outcome. Because what that means is, although there's been some work to try to standardize those contracts, in reality, and with apologies to all the lawyers who are here, how many financial institution and fintech lawyers do you think are going to take a model contract and just say, this looks good to me, let's do this, boilerplate, we're not going to make any, again, apologies to the lawyers. So what you end up with is you end up with different outcomes for consumers because each contract is different. The protections that are in place for you if something goes wrong is different. The authority that you have over your data is different. And so thinking about this less in terms of just the technology, but in terms of the policies that govern this market, gets to what you heard Jason say, what you heard Kelly say. Do consumers have access to these tools that are both available today, but will be available in the future if full utility of that data is provided to them?
Leila, if I can come to you, your written statement argues explicitly for the necessity of bilateralism combined with multilateralism. Is Steve right? Is that bilateralism a necessary evil, or is that a long-term necessity?
Yeah, evil is a strong word, as somebody else said. So I think, I definitely see how it would look complex to the downstream consumer if every aggregator, fintech, is going through a different set of negotiations with a different bank and ending up with a different set of parameters. I think for the most part, though, most of us banks have very similar requirements. They're regulatory and obligations and legal obligations that we feel like we're under, that we all essentially abide to and take it really seriously. So for the most part, all the, key sections of that agreement that you will see from bank to bank or financial institution to different financial institutions are very similar terms. We might word it differently, we might, go at it a little differently, but I don't think that's the hurdle of getting us to the next phase. I think the one of the challenges, at least from what I understand, that one of the challenges are, there are several challenges. One is the consistency of the various data elements that are being shared to the end user. And from an angle of what does the consumer have the right to share and what they don't, I think it is becomes, and somebody, I think it was Jason that referenced taking your bank account statement in a shoebox to from one place to the other and sharing it. It's very different when you're sharing it over cyberspace, right? So the security stakes are much higher, and we take that really seriously, and I think all the other large banks, or banks do too. I shouldn't say large banks, because this is a problem across the whole ecosystem. But I think in addition to the data elements, there is the control issue, and the fact that today when you share your username and password, you're essentially, I've made this analogy before, and people thought that made it clear, but I'm surprised that it takes that. But the analogy of giving your house key to a house painter and say, just go in my bedroom and paint that one wall. That's all I want. And then the house painter has your key forever. And they come and go as they please, and they look at things and take things if they want. And so the idea that you open up this space by sharing username and password, I think that's one of the key obstacles for us to move forward in the space of data sharing. So, data elements, I think we can get there. I think we're definitely in discussions, whether it's an FTX and other places in the industry, in various industry organizations. And I think doing away with credential sharing and moving to a tokenized access not only allows the customer to select what they want to share, they're presented with the account selection screen, but also through the portal. Everyone talked about Control Tower. I should too. It is.
It's yours.
It is a place where you are able to permission moving forward. Like you went and gave permission to an app, and you said, "Take all my data? No, I don't want that." So you go back and see what they have access to, and you're able to pick and choose, even after the fact, at any point of that interaction.
Kelly.
I think that in our paper, we've tried to separate a question between the outer bounds of access as permitted by 1033 and the inner bounds of access that you would have for a particular use case, because I think they're kind of two separate questions. And you potentially have a lot of tools for the second question. One is to restrict the flow from the very start, but the other is to restrict it along the way or to put boundaries on how you use the data. So there are more tools, both for industry and for regulators to use with that second question. And it's challenging right now, at least in the credit use case, because we don't know what data works best. We have a sense that, people are still experimenting in this space. They're still learning. We had a wide variety of variables and attributes that different companies were using when we were doing our empirical research. There's still a lot we don't know. And so it is challenging because like I said, there's a desire to get everything right from the start, and yet there's a tension with that in terms of evolution and innovation and figuring things out over time. And I'm not sure that that's true in every single use case to the same extent that it is in credit, and maybe it's different in payments, I'm not sure.
Right.
But I think it is challenging, and I think it makes minimalization one of the hardest pieces of this puzzle to solve for industry or for regulators.
And I'm sure we'll get to that on panel 3, but Jim, yes.
Yeah, back to the multilateral or bilateral agreement issue. I don't think when you're in an innovative world, you will ever see anything but bilateral agreements. We talk about networks, payment networks, as though they've always had multilateral agreements. They have not. And I can tell you firsthand, we were the 4th bank in the nation to be part of Clear Exchange, and then now has become Zelle. Our agreement was bilateral. Now they have a multilateral agreement. That happens when a business starts to mature and the vision and where we're going is clear. I think what Jason is doing is amazing, and I bet if we would have tried to regulate or dictate what an agreement looked like 3 years ago, we probably wouldn't have thought of some of the things he's doing. So I think we need to respect a market that's evolving and just know there's going to be bilateral agreements, and then as things start to stabilize and become more clear, you'll have an Akoya, you'll have things come forward that will help smaller and medium banks, because we do not have a cadre of lawyers and things that will look at things. So we will look at an agreement that's been used by 1,000 FIs and been reviewed by regulators and take some comfort in that. But it'll be when the business matures.
That's a very interesting point. I'm thinking about the fact that Visa has obviously recently moved to join this market, and as an ex-payments lawyer, I think about the extent of the Visa rules. I mean, that's a fairly broad multilateral document, so maybe things are changing in that respect. Lightning round for everybody, and I really do mean lightning, because we've got a grand total of 3 minutes. I'm trying not to look at Max in case I'm wrong. If you look at this market in terms of historical perspective, go back a few years and then cast your mind forward a few years, where are we in that evolution? I think one of the themes I've heard today is that maybe the permissioning system, in Jim's phrase, is the place where there is the most work to be done, but I think I hear other themes as well. But if each of you, and I'm going to go down the row, Steve, starting with you, where are we in the evolution of this market in terms of market developments, not regulatory developments per se?
Significantly moving forward on technology compared to where we were before. On governance, still kind of stymied by a lack of clarity from policymakers.
I think I would agree with both of those two things. I would say two other things. We're hearing a lot of interest on standards, not on the front end about moving the data back and forth, but on the back end around security, liability, insurance, investigations, some of the things that the payment networks have kind of built over time. So a lot of interest there, and I think Nick touched on the prior panel. The other thing is I think a lot of uncertainty. I know a lot of people have been talking about collaboration and coming together, but we're also hearing a lot of uncertainty right now, especially around the recent acquisitions, to be honest. I think we're seeing a lot of large players in this space in new ways, and that does tend to raise a lot of concerns for smaller players. There is interest in having utilities and trying to figure out the tail for small entities. There's no question that has to be solved here, but also a lot of concern because there's a lot of mistrust, to be honest. And we're sensing that that's picking up maybe a little bit right now in light of those acquisitions and various other things.
Interesting. Leela?
Totally agree with the uncertainty. I think in light of all the acquisitions and the movement and shaking that's happening around the marketplace. But I happen to be really optimistic about the future of this space. I think with all the different, movement and work that we've done in FDX with bringing everyone together under one umbrella so that at least we can have the conversations, I think that's kind of a key point in terms of technology, in terms of, transparency and moving together in that direction. I think we're in a really good space.
Jason?
I would say that, we're at a critical inflection point now, a real fork in the road, where on one hand, the demand from consumers for fintech applications has never been greater in the U.S. and around the world, right? So, the majority of U.S. consumers have a financial application installed on their smartphone. But at the same time, the U.S. has lagged behind other peer nations in ensuring ongoing real-time availability of consumer financial data to the detriment of the consumers that are seeking to use these various products and services. But because the demand is so high, we're starting to see real, I think, competitive interests begin to emerge in this space, right? Where there are lots of consumers that are choosing to get their financial services online or through an application, oftentimes through the use of this information. And we are in the midst of a takeover of the aggregation networks by the largest custodians of the data, right? So, even the aggregators we heard from this morning have significant financial ownership from credit bureaus, from payments networks, potentially. So we have more and more, increasingly, the institutions that are custodians of the data, that are not seeking access to the data, and that would face increased competition if the data were shared and available to the ecosystem, that are in position to make the decisions about who can use it, what the use case is, how much friction the consumer has to go through to access their information. And so, I really think that this is the moment where we have to see the government act, where the market's not going to solve
narrative
these
foreshadowing of panel 3.
problems on
Thank
its
you.
own.
Jim, last word for you.
All right, I had a lightning round, but I also have a response to Jason.
Only if it's a lightning response.
It'll be a lightning response. I think it's important we keep a lens on the consumer. After all, it's the Consumer Financial Protection Bureau. And we as a bank have always wanted to meet customers where, when, and how they want to be met. And if they want to use a fintech, we're all for it, but we want to do it with transparency, customer and complete control. We're in the trust business. If we don't get that part right, we will lose everything about our banking business, and that's not something we take lightly. As far as the competitive issue goes, I compete with over 5,000 other financial institutions. I have no problem competing with someone else. It's something we do every day. So to imply that that's part of the reason we're withholding the data, I don't think that's the case.
And with that, I must hand it to panel 3. Thank you all very much.
Thank you, Will. Thank you to the panel. We want to be back by noon, so this will be a little bit of an abbreviated break. Also, real quickly, apparently there's a smart card, Metro smart card, that has become separated from its rightful owner. If you're missing yours, please go see Isabel out front at the table. She has it. Thanks. Hi, folks. Just a 2-minute warning on getting going with our third panel to keep us on track. Thanks. Hi, folks. If everyone could go ahead and start migrating back to their seats, please. We want to stay on track and get going with our third and final panel. All right. With that, we will begin. Tom, the floor is yours.
Thanks, Andrew. My name's Tom Devlin. I'm a managing counsel in the Office of Regulations here at the Bureau. I'm very excited to introduce this panel. We've managed to wedge an extra chair on stage, which is good. I thought I was going to have to stand at the podium for an hour. So the first two panels sort of talked about where we are, how we got here. This third panel is more focused on where we're going and how we get there. But you don't want to hear me talk about this. You want to hear our panelists, so let me start by introducing them. Immediately to my right is Chi-Chi Wu. She's a staff attorney at the National Consumer Law Center. Next to her is Tom Brown, who is a partner in the Antitrust and Competition and Global Banking and Payment Systems practices at Paul Hastings LLP. Next to him is Jane Barrett, the Chief Advocacy Officer at MX. Next to her is Dan Murphy, Policy Manager at the Financial Health Network. Next to him is Natalie Williams, Managing Director and Associate General Counsel for Responsible Banking and Data at JP Morgan Chase. And finally, next to her is Brian Knight, the Director and Senior Research Fellow of the Program on Innovation and Governance at Mercatus Center at George Mason University. So let's jump right into it. As the Director noted in her opening speech, the CFPB approach to this issue so far has not generally included direct regulatory intervention. But as you can tell from the written statements and the discussion so far today, that doesn't mean there aren't questions about the state of the regulations in this market. So I'll start it off with Brian. What are the biggest areas of uncertainty, and where are those areas of uncertainty having an impact on the market?
Thank you. So, yeah, I mean, it struck me that in all the conversation today, one area that's been sort of under-discussed, and perhaps intentionally because we're the third panel, is like, what does the actual law require, right? Because like Congress did a thing. It assigned a property right. And a lot of the question and fight is now, well, how far does that right go and under what limitations, et cetera? And so, and I think that's where the real ambiguity that needs to be resolved is one, when we say a consumer has a right to their data, do we include the consumer's agent? And, you know, the U.S. Treasury made that argument in their FinTech report. And there's some force to that argument, right? It's logical. And then if, in fact, the consumer's agent has a right to data on behalf of the consumer, then the question becomes, well, on what terms and who gets to impose those terms? Do the banks get to say, in effect, we will not allow this consumer's agent to access data because we are uncomfortable with them or whatever? Does it have to be the CFPB who says, okay, financial institutions under these conditions you can refuse access? And then where is the CFPB limited as to what they can do? Because the CFPB, well, it says subject to rules prescribed by the Bureau, there are hard limitations, or at least hardish limitations in the statute itself, and presumably Congress did not intend for the subject to rules to swallow up the underlying right.
So, Tom, any quick reactions to that?
Yes. Brian is probably the most free market person up here, perhaps aside from me, the lone competition lawyer, and I think he agrees that the issue here is ultimately what does the law require, who gets to decide. It is not often that 10 years after Congress acts and the president signs legislative language into law that we have this sort of open question. And the statements both from the podium and the written submissions fall into two camps. They can be identified as bank, not bank. Banks take the position, there's nothing here for the CFPB to do. Don't require us to provide consumers and their agents with access to information. That's the bank position. But do regulate anybody who touches the data. So we'll call them larger participants. They need to be regulated and scrutinized. Come back to that. And then there's everybody else. And everybody else starts with the premise that Brian started with, which is the development of this industry is stymied by the fact that financial institutions, and not just banks, but financial institutions as a whole, do not recognize the clear and plain reading of 1033, which is that consumers get the right to provide themselves and their agents with access to their financial information. And we can see that across the industry. There are some wonderful examples, right? So the spat between PNC and everyone. USAA and everyone, State Farm and everyone. But outside of the banking world, right, there's a piece of litigation now pending in the District Court of New Jersey between SpeedPay and Bilgo about whether SpeedPay can block access on the part of Bilgo to consumer permissioned access with regard to how they pay their bills. Like that, this is crazy. Like, this is a decade after Congress said consumers get access to this information.
So let's jump from that and hear from the bank. Natalie, any thoughts on this?
Fake news. So first, it's very interesting, Brian, that you say that 1033 gave consumers a property right. I don't think it did that at all. But it did make clear that consumers have a right to grant permission to third parties to their data, right? And the reason I jokingly said it's fake news is that there are a number of initiatives, we heard about them on the first panel, that make it very clear that everybody accepts that, right? Everybody understands that consumers have a right to grant access to third parties who've been permission to use their data. That is the sort of the core, the first principle of FDX. But the question is, and that also has been resolved, but the question is how? And they have to do it safely and securely. That's what consumers expect. That's what they need. So I think it's a bit of a red herring to say that we need all of this regulation to sort of world build around 1033 when there's so much going on. And we can talk about it a little bit later because I know you want to highlight some of the other issues that are percolating in the market. But there's a lot of widespread agreement. And we think what is not being focused on enough is the second half of it. You can have consumer data access, but then you do need to make sure that this information, which Congress has recognized, and I think we all recognize as consumers, is highly sensitive, that it's no less sensitive when it's held by financial institutions than when it's held by aggregators and fintechs, right? And so we want to make sure that it's protected in the same way, because consumers and the information deserve no less protection, be they held by a fintech, an aggregator, or a bank.
And Jane, can we get the global aggregator perspective here?
Sure, and I'd love to provide some context first. Amex works with about 2,000 different financial institutions, and the majority of the conversation today has been about taking data from a financial institution and passing it through to a fintech, but there is a massive use case which is bank to bank, right? Many humans have multiple financial institution relationships, and they are using aggregation to see their complete picture. And I think that is something that is really important to call out. And to pick up on Brian's point around just the uncertainty around access, we would agree. I mean, there's been 10 years of arguing around just what 1033 actually means. Clearly, as an Australian, I'm biased, but for the Australian government to pass a consumer data right, that provides nothing but clarity, because then everything falls under this idea of ownership. Security, privacy, agent rights, transferability. That piece of 1033 clearly has provided a lot of uncertainty, and an idea of an ownership right and a data right is something that would go a long way towards solving for that. And then I think the second piece of uncertainty is around data parity. So there hasn't been a clear view around just what consumers can be legally able to access and share.
Brian, you have a quick thought here?
Yeah, so just wanted to respond a little bit that I think the question or the framing of how we answer this question matters. Do you view it from sort of an ecosystem perspective, or do you view it from an individual customer perspective? Because if you read 1033, and I'm not saying this is the right reading, but it's a plausible reading, that the financial institution shall make available to the consumer, and then you read in the agent part of that from the definition, right? Then I guess the question is, in a scenario where do we think in a scenario where the consumer goes to the bank and says, look, I'm working with this fintech, and it's, Belarusian, not at all sketchy at all fintech, but they're my agent, and look, cough up my data. Does 1033 mandate access in that scenario or not? Can the financial institution on their own say, I'm sorry, we'll do it if you work with any number of fine, well-known, relatively safe institutions, but not these guys, even though they're your choice? Can the Bureau say that? I mean, and I think that these are unresolved questions, and let me just get ahead of something by saying I am entirely willing to believe that Congress made a mistake, right? Congress screws up sometimes. So we can have a scenario where the law requires something, and we all look at it and say, boy, that's unfortunate. But, if that's what the law requires, that's what the law requires. And the remedy is Congress fixing the law, not, I would argue, us ignoring the law. And I think that that's the challenge. And like I said, it's entirely possible that reading of 1033 is wrong. I'm not endorsing that reading. But it's a plausible one, and we need to figure that out.
So I want to build off something that Jane was talking about, which is looking at the use cases. We've talked a lot in the first two panels about some of the more common use cases. Those include things like underwriting in a number of ways. And so, Chi-Chi, do you have any thoughts about some of the impacts of various credit-related regulations in this area?
Oh, of course I do. So first, I wanted to thank the CFPB for having me here. I'm especially appreciative because I'm having a lot of fun with this discussion, and I really, really just love hearing the banks and the aggregators both talk about how much they value the interest of consumers and how important it is to protect the interests of consumers, especially this idea that consumers should have lots of control over their data, and data security and preserving that data is so important because I want to know where those considerations were or are when the banks are giving their data over to the credit bureaus, where we have no control and no ability to designate what information and what level of information, and we can barely get or not get errors fixed. And so the use cases, Kelly Cochran in the previous panel made a compelling case that credit underwriting is a valuable use of this data, and it looks like it's going to help consumers, and we think that we agree with that as long as there are these controls that we're talking about. I mean, we do have an ability, all sort of snark aside, we do have an ability with cash flow underwriting data to create a system that is better for consumers than the traditional credit reporting system. That we have the ability where consumers can opt in and not be forced to give their data over, where they have way more control. So I do appreciate that, and I do support that fully. But when data is used for credit underwriting from a third party, it clearly falls within the Fair Credit Reporting Act. As folks who are familiar with the FCRA know, it has a broad definition. A consumer report under the FCRA isn't just a report from Equifax, Experian, or TransUnion. It covers things like criminal background checks and tenant screening reports and even medical information databases. And so, clearly, credit underwriting is right in the heart of those purposes that the definition of a consumer report revolve around. You've got the type of information that's in a credit report, so not only credit capacity and creditworthiness, but things like character and mode of living. And then you've got that it has to be from a consumer reporting agency, which is an entity that for fees, dues, or on a nonprofit cooperative basis, assemble or evaluate data. And so this stuff falls smack. You don't even have to go to the more out there kind of data like social media, or the sort of the whether or not this use falls in the FCRA. It falls smack in there. Now we've heard arguments that no, it's not covered by the FCRA because it's consumer permissioned. Well, first of all, you heard in the first panel from Christina Tetrault that this permission's a little bit sketchy. It's in the MICE type. And second of all, there's no reference to consumer permissioning in the definition of consumer report or consumer reporting agency. It doesn't matter. And it certainly can't matter because if consumer permission data was exempt from the FCRA, every single loan contract in the United States would have consumer permission. I grant the ability to share my data with Equifax, Experian, and TransUnion, because then they wouldn't be consumer reporting agencies anymore. And even better, the lender wouldn't be a furnisher under the FCRA, and they would all love to get out under it. So obviously we cannot, the dividing line can't be consumer permissioning. There's also been an argument that we can't be a consumer reporting agency because there's no furnisher. The banks aren't furnishing, they aren't actively transmitting this information. But the FCRA doesn't actually require an active furnisher. It does have a role for furnishers, there are duties of furnishers, but there are consumer reporting agencies that get data, that pull data from passive sources. Public records, criminal background check agencies are a classic example. Now, whether the bank is a furnisher is a whole different issue. And that is an important issue because, one of the key principles of the FCRA and one of the key principles in the CFPB's principles from 2017 on access to data is accuracy. And of course, as a lot of folks know, the FCRA does have accuracy standards, and it does have a mechanism to dispute inaccurate information. And so, you've got a ready-built mechanism for dealing with accuracy disputes if you properly follow the law, which is a whole other issue. But if you don't have a furnisher and you don't have an underlying data source that will also be involved in the dispute, then you do have issues. And I think that is an area where you have to think about the intersection of 1033 and the FCRA and where Bureau guidance could be useful.
All right, so let's put a pin in the FCRA issue. Natalie, I want to give you a chance to set up an issue that was in your written submission, which is issues around the Electronic Fund Transfer Act.
Yes, I think we've talked a lot about consumer control, and hopefully we'll get into how we make control meaningful. But it is we have three main principles, and just to sort of level set, we at JP Morgan Chase have been in this space for a while, and we have done a ton of work to try to promote what we think is in everybody's ultimate goal, which is safe and secure access, where consumers can decide what data they want to share, for what purposes, for how long, and importantly, and this is where Reg E comes into, where market participants are responsible and accountable for the risks their activities create. And so we have Reg E, which allocates liability between consumers and banks. And when Reg E was adopted, certainly no one was thinking about this ecosystem where you have myriad players getting access to very sensitive information, which easily, according to the recent statement by the head of FinCEN, that easily can be used for inappropriate purposes, or these companies like aggregators and fintech platforms can be exploited for account takeovers, fraud, unauthorized transaction, and identity theft. So we're sitting in a situation where we have sort of a square peg being forced through a round hole. And so in situations like this, where many aggregators and fintechs, if you look at their terms of conditions, they disclaim all liability, all or most liability to consumers, maybe $100, maybe $500 for some, for unauthorized transactions. You have a situation where that's not only unfair, but also undermines consumer protection, because there's a great deal of protection where you place liability on the actors best suited to manage the risk. Because if you do that, you give them a powerful incentive to do so. You give them a powerful incentive, in this case, to ensure that they have bank-like security standards, information security standards in place. You give them a powerful incentive to push those information security standards down on their third-party clients who are going to access this data. And equally importantly, you give them a powerful incentive to do what Brian was sort of referencing, to vet and ensure that you're not sending your vet and monitor their clients, so they're not sending data to Belarus.com, right? So we think that there are some clear uncertainties with respect to Reg E, particularly in the money movement context, and we believe that the law is clear, and the CFPB probably should affirm that in the money movement context, where an aggregator is given an access device and there's no agreement with the bank, that the aggregator is a service provider and as such should be liable under Reg E. But we really think that while that would be helpful, that is not sufficient at all. And the reason is because, as Jim pointed out, the banking system, our business, is fundamentally based on trust. Trust that consumers have that we will protect their money and that we will keep their information safe. That is our core brand promise at JP Morgan and any financial institution, small bank, large bank, or what have you, right? And all of these rules, GLBA, Reg E, an array of other statutes are designed to promote and protect that fundamental trust that we all need for the secure functioning of the banking system. So even if the CFPB were to do as I urge, and I assume many of my peers in the industry urge, clarify Reg E, that's a little bit beside the point, because fundamentally our customers, because they have trust in us, will come to us to make them whole in the event of losses, right? They will come to us and ask us to help them with respect to identity theft. So we're going to face a lot of loss. And so what have you set up here? A system where aggregators and fintechs may not have sufficient skin in the game here because someone else, the banks, are going to be underwriting and insuring those losses. And I don't think that that is a system that promotes consumer protection. And so in our agreements, we've tried to tackle these sort of misaligned incentives. First, by ensuring safe and secure access. Second, through an API, the tokenized authentication mechanisms. Second, we have imposed bank-like information security requirements. We have also required the aggregators and fintechs, and I should point out, we've entered into agreements with fintechs, both fintechs and aggregators, the large and small players, like including Expensify. But we've said that if you're an aggregator and you're passing information down, information is no less sensitive in your hands than in ours. So you need to pass those requirements down, those information security requirements down to your clients. We've also imposed insurance and indemnification obligations, right? So that you can make sure that, again, the aggregators, the fintechs, who are getting this information or passing it along have skin in the game, and they will therefore take the necessary steps to police it. We don't think that that alone, a contractual arrangement, will ensure robust, consistent practices across the industry, and that is why we argue that the CFPB should affirm, consistent with the FTC, that aggregators are financial institutions, and and coming from this agency, I think, and believing very strongly that regulation and supervision and examination makes the entire system stronger, that we think larger participants in these markets should be regularly examined, should be subject to supervision, and the CFPB should certainly look at the market and exercise this larger participant rulemaking authority.
Great. So we've identified on the panel a number of really interesting issues, and I'd like now to turn to the panelists' thoughts on what the Bureau should do here. This is obviously a market, as we talked about in Will's last question, that's still in a significant period of changing growth. So what should the Bureau do? When should the Bureau do it? And I'll give Tom the first crack at that.
Thank you, Tom. I didn't mean to steal Natalie's thunder earlier by saying that the banks take the position that the only people that should be regulated in this space are the aggregators and not the banks with respect to 1033. Anybody who read my submission, and I know we now live in an era in which people are awash with the ability to read stuff, knows that I believe exactly the opposite. We've been waiting for 10 years. For the financial regulatory space, the Bureau, the Prudentials, to clarify that financial institutions have a clear and unambiguous obligation to provide consumers and their agents with access to financial information. Shall, as is often noted in many a court opinion, means shall. 10 years for waiting for shall is too long. For those race fans out there, it's time to drop the green flag. Now, having said that, since that was short, I want to circle back to a couple of other issues. I have often a reputation, I have lots of friends in this room, for being disagreeable, but I want, apparently, some victims of my disagreement. But I want to say, so there's a lot, actually, that I agree with in what Chi-Chi said. And for those who saw us on testifying last year in front of House Financial Services on the FCRA, know that at least from my perspective, the debate about 1033 and the responsibilities that bureaus have with respect to financial information are sort of this weird parallel, right? Like, it's kind of like Superman and Bizarro Superman for either Seinfeld or DC Comics fans.
Wait, who's Bizarro Superman in this one?
So the Bizarro Superman is the bureau space, right, where consumers have no ability to control who has access to their information, no transparency into how that works, and where the third parties are not accountable to consumers. So where we disagree, however, right, is that, and I'm going to take a line from Brian. So, Congress often makes mistakes, and at least from my perspective, as a matter of legislative action, the FCRA is just a walking example of a legislative mistake.
I might have to disagree with you on that one.
No, it's not with respect to purpose, right? It's that the legislative text is completely unparsable because all of the action is actually in the definitions. And a credit report is a specific thing under the FCRA, and it is a thing that is received by an underwriter from a third party who does not have a relationship with the consumer. And so when you apply that definition, which is what the FCRA says, to the consumer permissioned space, it is actually quite easy to see why consumer permissioned information is not covered by the FCRA. We can sort of skip the technical details about how you get there, but both the FTC had ratified that when it had interpretive authority with respect to the FCRA, and there are sort of easy ways to implement the consumer permissioning of access to information that don't trigger FCRA concerns, namely the consumer gives you the data. So now with that said, right, there are important issues that are at stake, accuracy, access, transparency, but we don't need to apply the FCRA to reach them. Nor do I think that there's great uncertainty with respect to the Reg E issues that Natalie raised. We might not like what Reg E says, right, which is that if I give my debit card to someone, here's my debit card, thank you Citibank for giving it to me, and say that UGG can go buy something with it, like you could go, I don't know, buy coffee for everyone, right? If you decided, well, I didn't want to buy coffee, but instead wanted to buy a plane ticket to Brazil, my dispute is with you, not with Citibank. That's what Reg E says. But if I give my information to you and a third party obtains it from you and then uses it to engage in an unauthorized transaction, I do have a dispute right with respect to the underlying issuing institution. Again, right, like we might not like what Reg E says, but that's what it says. Now, the CFPB can clarify it, but to take a line from Kelly earlier, right, like at some point we have to stop letting the perfect be the enemy of the good. We've been waiting at the starting line for 10 years. It's time to drop the flag and let people race in this space.
So, Dan, this discussion's been touching a couple of topics that are in the Financial Health Network submission, so I'd like to give you a chance to chime in here.
Yeah, sure. So a couple different points to pick up on. I think broadly on maybe both Reg E and FCRA, I'm struck by, it seems that you could get pretty broad agreement in this room to the statement that there is no confusion on either insert FCRA or insert Reg E here, but it's a lot harder to get agreement on either how FCRA applies or the confusion around Reg E. So I think the fact that we're talking about it is an argument in favor of the Bureau providing that clarity. On 1033, I mean, I think, we've come out and said the Bureau should affirm access through a formal rulemaking process. A few things I'd like to say here. I think in the wider argument, the wider space around, consumer data rights, there's a lot of questions about what can be done and who can do it. In this space, that's not the question at all. It's very clear what can be done, and it's very clear who can do it. So I think that the Bureau has a pretty unique opportunity here to play a role in this space, and it should really not let that go. Second, the Bureau's questions sort of indicate that there's a lot of concern around maintaining competition and innovation. And, I agree with Brian and I agree with Tom that is an important goal. I think as we're thinking about that, I understand the hesitation to do rulemaking too early, but this space has matured quite a bit, and it feels now like regulatory uncertainty is a little bit more of a barrier to competition and innovation than premature rulemaking. I'd also point out that just as we're seeing a lot more acquisitions in this space and as a lot more large players are getting involved, we might be at sort of an inflection point where up until now we've seen consumer data access really being enabled by screen scraping, and that's really enabled a second order of business competition and innovation. Now what we're seeing is larger players getting involved, and in a lot of ways that can be really good. There's been a lot of discussion about the security issues and the privacy issues that are inherent in screen scraping, and that is a near problem that we need to solve. But we wouldn't want the pendulum to swing too far back and thereby hurt competition and innovation. So I think the Bureau really has a strong role to play in ensuring that those gains are maintained.
So, Jane, any thoughts about the timing and necessity of a Bureau action here?
Again, 10 years has been a while, so sooner the better. I think there's there's three core pillars that need to be addressed. You asked the question, what should the Bureau do? And these are in parallel. I don't think they're sequential, but sort of first up, providing transparency. And amongst all of the things that we've talked about, especially transparency around Reg E as it relates to the wider ecosystem. I think there's a lot of learnings we can take from Europe with the third-party providers being registered, having to pass through a qualification exercise. But from that exercise, then we can have better transparency and better access into ideas like liability. Right? So at the moment in bilateral agreements, there's multiple ways that different FIs are addressing the liability question. As Natalie said, there's insurance requirements. Again, they're very divergent from institution to institution. So having transparency around Reg E as it relates to liability and insurance requirements and just who the third-party providers are and what their responsibilities are, like that is a crucial element to be able to really grant these data access rights sort of in reality. The second pillar, I believe, is consistency. There are institutions in this room that are multiple years ahead in terms of their tech readiness, their policy readiness, their legal readiness, their organizational readiness to do secure data sharing. The long tail of the industry is, as I said, a couple of years behind. So enabling a level playing field for all institutions versus just the ones who have been able to invest over the last few years is really important. And then the third pillar is around recourse. There are institutions who will, actively block. If there are, again, elements and processes in place to safely and securely share data, that decision by an institution to block access to a customer's data, because there will always be safety and security concerns, but at the moment it's very monodirectional. It is at the decision of the FI. So some transparency around that. And then what is the recourse? Like if a consumer can show harm that I have lost access to my data, I no longer as a small business owner have access to credit because my data has been stopped. Like what is the recourse right now? We haven't seen any precedent there.
Can I just take a contrary position?
Absolutely.
So, we had the first panel, and you had members of the Financial Data Exchange. There has been so much progress. It's not all doom and gloom. To say that it's 10 years and no one can get access to their data is just really fake news. So I think the reason why I think the Bureau should focus its attention, its regulatory intention, its rulemaking authority on sort of, to me, more pressing issues is because defining this right of consumers to grant third parties access to their data is pretty clear. So first, there is broad agreement in the market that consumers have the right to grant permission parties access to their data. The core operating principle of the Financial Data Exchange is that consumers, I quote, should be able to effortlessly grant, modify, and revoke access to their financial data for applications and services they desire to use. FDX members estimate, as we heard earlier, that over 8 million customers are using the Secure API standard today, with 12 million on track to be using it by April. And since the principle's release, financial institutions have entered into these bilateral agreements with aggregators and fintechs. At Chase, we have negotiated, and I've been engaged with many people in this room in discussions, very productive, both large and small aggregators and fintechs that cover 95% of the traffic that's coming through our portals. And we're steadily migrating customers. Today, over 3.8 million of our customers are securely sharing their data through an API. The model agreement, which was discussed earlier, the TCH, with input, I would add, not just from its member banks, but from many of the aggregators in this room, the model agreement is designed to facilitate smaller institutions, both fintechs and financial institutions that don't have the resources of a JP Morgan or a Wells Fargo to be able to sort of jumpstart those negotiations, to reduce the time to contract and to make things more efficient. The second area around which, and we heard it in both panels, that there's widespread agreement is how that access that we all agree should occur, how that access should and should not happen. Very contrast to 2016, it is surprising to me that there is widespread understanding and recognition that credential-based access is unsafe and insecure and can facilitate things that we don't like account takeovers, like unauthorized transactions, identity theft, and other types of fraud. So again, that is what FDX is trying to do, working with all the entire village, right? The financial institutions, large and small, the aggregators, the fintechs, and with input from consumer groups who also participate in FDX to create a common interoperable standard that everyone can leverage. Third, as we've heard about, again through FDX, all of these market participants are working collaboratively on identifying the required and optional data elements for particular data use cases. What are those guiding principles that is defining that work and shaping that work? One, again, customer control over data access and use, transparency over how, when, and for what purposes and for how long data should be accessed, and data minimization, a key emerging privacy norm. That's the other thing that I do in my day job. And we, at JPMorgan Chase, I have to give a plug out to our own transparency portal, AccountSafe. We have been, along with other financial institutions, trying to do our part to provide that necessary transparency to customers that truly enables them to exercise meaningful control. So AccountSafe allows customers to easily see in one place the applications that are accessing their data, the specific accounts that are being accessed by those applications, the specific categories of account information they're accessing, when that information was last accessed. As someone mentioned earlier, there is a process of companies just continuing to access long after you've forgotten that you had actually signed up for this. And very importantly, in terms of control, the ability to revoke that access. And fourth, one thing that didn't come up that is really sort of critical, I think, to this question of the I think the big hole in a structure here, which is the lack of consistent regulation for all market participants, it's not regulation, consistent supervision for all market participants. We've tried to address that issue as well. So TCH, member banks, and leading aggregators have teamed up with a third party to pilot an assessment vehicle that would assist financial institutions, aggregators, in doing the security assessments and due diligence necessary to try to vet both the aggregators and the fintechs. I forget who mentioned earlier, it costs a ton of money and it's totally inefficient for us to constantly have the same assessments going on by multiple parties. So we're working together to see, can we do something to leverage it? So, clearly, I'm not trying to create my own fake news. There's a lot more that needs to be done here, but there's been a ton of progress being made, right? And the CFPB's approach, a principle-based approach that is flexible and allows both the technological innovation that we know we will see in this market, as well as emerging business models and other solutions, has really been instrumental in driving the progress that we've seen forward. So I think that the CFPB should take its limited rulemaking attention and regulatory attention and focus it on things that will clear up that hole on the other side in terms of making sure you have a level playing field with examination. That's what's happened in UK open banking, for example. They didn't start out just saying, let everybody have access. They did it in a framework where all of the market participants are regulated by the same entity, the Financial Conduct Authority. So
Natalie, can I cut in? I think Brian's been itching to make a point for a bit.
So if I could just say two things really quickly. One, the scenario Natalie's describing is great. Like, it is objectively a good thing. That isn't necessarily the same thing as consistent with the mandates of the law. And so to the extent that it is inconsistent with the mandates of the law, in the sense that, financial institutions are saying, customers, we give you many options. Well, I want this other option. Well, you can't have it because we don't consider it safe enough, whereas the law arguably requires them to open up. Then, it's a good world, but it's not the world mandated by the law. And, just interests of, I guess, rule of law would encourage us to move the regulatory picture towards that which is mandated by the law. Now, on the flip side, I would be remiss if I didn't point out that clarification is not the same thing as amendment, right? You can clarify ambiguities in laws and rules. You can't the CFPB cannot and should not rewrite laws and rules de facto to modernize them, even though many of these laws and rules were passed a long time ago in a different environment. There are undoubtedly rough edges that may result in outcomes, particularly within the field of liability, right, where I think the banks have some very valid concerns. But Reg E is what it is. And, EFTA is what it is. And so maybe there are some areas where clarification can grant relief, consistent with the obligations of the law. Cool. But we shouldn't be doing that. We shouldn't be de facto amending the laws because, well, geez, it doesn't work. Congress should be doing that. And, to the extent that the CFPB, if we were to implement the law as written and we look at it and we say, wow, this liability regime is suboptimal, it's unfair, it just doesn't make sense, but that's what's required by the law, then Congress should be the party that fixes it. And hopefully they will. But I get very nervous to the idea that an administrative agency is going to run the risk, and I'm not saying this is going to happen, I'm just warning of the possibility, run the risk of feeling a lot of pressure to clarify rules or laws in a way that actually goes beyond the scope of what Congress empowered them to do, even if it results in a short-term, more optimal outcome. There's still some damage being done to the broader system.
Chi-Chi, you had a thought on the EFTA point?
Well, I wanted to respond to both Brian and Tom on the EFTA point. Folks, these are people's money we're talking about. And when 40% or more of the population can't come up with $400 to cover an emergency, the idea that you're going to hold consumers on the hook for any situation in which a data aggregator is involved, even if it's the rogue employee, I think is just terrible. Going back to that analogy with the credit card, it's more like if you gave me your credit card number as a big online vendor and one of my employees made an unauthorized purchase to hold me responsible. I don't think that is the law. I don't think it's Reg B, and frankly, I don't think it's right. And we should make sure that in this situation, the consumers are protected, they are made whole, and they are made whole quickly. Because the other thing is, if the bank and the aggregator are fighting over liability, the consumer has to get access to the money right away so they don't overdraw their account, so they can make rent, so they can pay all their expenses. These are people's lives we're talking about. And so I do think there needs to be some regulatory clarity, whether it's guidance rulemaking or supervision. I mean, and this is to move to the point of, one way to deal with this in a more efficient, possibly more efficient way is to do a larger participant rulemaking for data aggregators. I mean, they're clearly providers of financial services or products under, several categories. If they're consumer reporting agencies, they may already be. And so, supervision can be another tool to make sure. And the CFPB supervises the big banks. And so in terms of if there's a denial of access, can it be dealt with in that context as well?
So can I take up the hypothetical? So sure. To be clear, Chi-Chi, if I give my information to you as a firm and one of the employees then engages in an unauthorized transaction, I actually have a chargeback against the bank, right? It would be a third-party penetration of that's a third-party penetration of your system. You would have to have misused the information and exceeded your permission. But otherwise, that liability sits with the bank that issued the credential. And I actually think that this is, an important point just generically, and B, it points to an issue that Brian raised about the sort of scope of law and in rulemaking and what markets are capable of solving. So. And I'll give you an example. I can, again, sort of reach for my props here. Here I have a Chase card. Thank you, Chase. Thank you, Natalie. Don't cancel my account. I have to get home.
You can come to us to have your losses underwritten.
Right. So once upon a time, we faced exactly this problem in the payment card space. So how do you assign liability for unauthorized transactions? And in a fit of relative genius from a regulatory perspective at the time, Congress and the agencies did not try to boil the ocean and identify all the possible permutations of how information could be misused. What they said was, if it's misused in the context of a credit card, the consumer's off the hook. And then y'all have to figure it out. And lo and behold, my friends at Visa, I am an alum, thank you, Visa, figured out how to allocate that liability across the institutional participants. Now, you might not like how Visa chooses to articulate, or how it chooses to allocate that liability. Many merchants don't, for example. But there's an allocation regime associated with participation in that ecosystem. The same thing could happen here if we agreed that consumers have an unmitigated right to provide information to third parties. Then I'm pretty certain the industry would figure out how to solve this problem, because it turns out computer scientists are smart, and you can separate read access from write access. Again, to cite the payment card context, authorization, when you receive account authorization, so when the little terminal beeps and you get to walk out of the store with stuff, that's just read access. The merchant had received a message that the consumer has funds sufficient to support that transaction in the account associated with the credential that was presented. The funds don't transfer. That write happens at the end of the day, and the funds actually move 3 days later. We know how to separate read and write. We can do that for consumer permission data access. It's time to start.
Okay, Dan, then Jane.
Yeah, just very quickly. I mean, I would agree with just the logic that if we agree that consumers aren't liable here, then the industry should be able to figure this out. We've advocated before for industry to come to a common liability standard, but the incentive structure within the lack of clarity that exists right now is it's just not working. I mean, we're just not getting there. So I think that the CFPB does need to provide that clarity so that, as Chi-Chi said, consumers are not the ones ultimately on the hook.
And to go like really big picture, there is an opportunity now not just to solve for the problems of today, but to really build infrastructure for innovation of tomorrow. And I think we look at things like privacy, safety, security as an outcome, but that's a great outcome for today, but is it setting us up for future innovation? And when you think about how much, the term data exhaust hasn't come up yet at this symposium, but there is so much data exhaust out there, right, on every single person in this room and every single person in the world. What we are doing today is actually starting to mitigate that entire industry of data brokers, of the underground data exhaust that's going on. And I think having a broader lens and a approach towards, again, ownership and an interagency view of, is data really an asset of a human person? And I think we can all argue yes, because it has been well monetized by the vast majority of companies out there. So if data is an asset, then is there a role for the FDIC to play? Is there a role for the Fed to play? Like, there is a lot that we can do, that we are basically building the bones of a future system that will have a lot more controls.
Jane, can I just respond to that really quickly? I think that's an important point that hasn't come up on this panel, this whole notion of consent and what the Bureau might be able to do to ensure that consent is meaningful, effective, and informed. And the overlay of the privacy debate that is raging throughout the United States and indeed the world because of increasing concerns among the public about unanticipated uses of their data, it features in these discussions as well. And regardless of what you think about a business model that says, well, you get this free personal financial management tool or what have you in exchange for us being able to monetize your data, we need to have, and I think the Bureau could do the entire ecosystem provide a lot of benefit by helping us understand how do you ensure that consent is meaningful? How do you ensure that you have a user-friendly customer journey or experience, maybe through layered notices, just-in-time disclosures, particularly around these downstream uses of data that are not not connected with the products and services the consumer has signed up for and don't provide an obvious direct benefit. But I just want to go back a second to Reg E and consumers not being liable and the misaligned incentives. Jane, that's exactly why we have insurance and indemnification requirements in the bilateral agreements. There would be no other way to ensure that the party best able to manage that risk actually has it. And so it may not be standard because the use cases aren't standard, right? So it has to be flexible based on the profile of the actor and it also how they plan to be using the data, how much data and the like. And so it has to be, it has to take those things into consideration.
Brian? Yeah, so just to pick up on something Natalie said, because I think it's important to think about when we think about the card network analogy, which is that, under one read of 1033, while Visa or the bank can refuse to do, Visa can refuse to do business with a merchant or something if they think that their security is not up to snuff, the ability of a bank under a strong agent read of 1033 is much more limited, right? If your customer says, well, this is my agent, then that's the question is, can the bank say, well, we're not going to do business with them because they're inadequate? Now, presumably, the bank can say, you're no longer our customer, right? Like, presumably, that would be an option that the bank has. It's strong medicine. So, I mean, in arguing, I know I'm arguing like all sides of this, but they put an academic on the panel, so what more do you want? Is like, part of what we need to wrestle with is, did Congress, in fact, create a situation where banks do lose their contractual power to assign, to arrange for these things because their customer comes in and says, well, this is my agent, and you have to do business with them or lose me forever. I don't know if that's the answer, but that's not an unreasonable read of the statute, I don't think.
Just very quickly to respond to something that Natalie said as well. I think the point about the importance of third-party liability insurance here is really important as well. I also just think it's a more important point for the larger ecosystem, just beyond any one financial institution, and something that should be encouraged more broadly. So just that point is, yeah.
Yeah, so I'm going to pet an elephant in the room here, right? Since Brian alluded to it, and it's not the hypocrisy one that Chi-Chi raised before. That one's over in that corner. The other elephant, the one that's over here, is the lack of competition fundamentally in the U.S. banking industry, specifically with respect to the mobility of core deposit accounts. My favorite stat for this, and I won't identify the source, is that when you have a joint account, mortality risk is actually higher for the participants in the joint account than the closing of that particular account. It is functionally impossible in the U.S. at the moment to move a core deposit account from one financial institution to another. So how does that link back to Brian's point, right? To the extent that the bank remedy, when they refuse to provide a third-party access to a consumer, is that they have to close the account and transition that account to some other financial institution, great. Like, the idea of actual competition for customer service and deposit relationships, and again, right, we've focused this conversation so intensely on the deposit relationship. Think of all of the other places where consumer control doesn't exist with respect to financial relationships. Again, this is something I talk about in my long submission on this point, and I generally tend to be sort of short in the writing, particularly when I'm doing it for free, but I really care about this issue. Mortgage servicers, not chosen by the consumer. Debt collectors, not chosen by the consumer. Third-party bill providers, not chosen by the consumer. These are all places where the same right is at stake. And it's, again, right, like, to come back to my sort of goofy analogy, right, like, we've had cars on the racetrack for 10 years. Like, we have to do that thing that they do at the Indianapolis 500 and wave the green flag and let people start operating in a world that would be consumer-oriented because consumers would have more permissions and more abilities than they do at the moment. Then, right, to tie this back to the global privacy issue, we now actually live in a world, or at least I do since I'm in California, where I can demand that my information related to my sort of social media accounts be transferred from one institution to another, right? So I could presumably tell Twitter that I want all of the information associated with my Twitter account, TPBrown5, to move from Twitter to somebody else, or from Facebook to somebody else. Like, but I can't do that with respect to my financial information. That's crazy and not good policy and not not fundamentally in the interest of consumers. And that right's not limited to California. That right's also part of GDPR, which Natalie alluded to earlier. So we should just get on with it.
So I do want to turn to another topic that Natalie and Chi-Chi have raised in various points, which is the question of supervision. Chi-Chi in particular raised the possibility of a CFPB larger participant rule in this market. Dan, do you have any thoughts on that?
Yeah, I mean, I think that, generally we take the view that, and I think probably a lot of us in the room would agree, that aggregators are relatively new participants in this market. And, we're all trying to figure out the best way to supervise them. But to us, that seems like a second order question after answering a lot of the questions that we've talked about here, 1033, FCRA, and Reg E. And to Chi-Chi's point, maybe they already are, depending on what clarity the Bureau should provide or could provide under FCRA.
Any other loose thoughts on the LP rule?
Yeah, I would just say that I don't think it's a second order point, because I think if you actually had a more level playing field and the CFPB was looking at the information security practices of the aggregators, if it was looking at whether or not there were compliance management programs in place, and it was finding both risks that they could alert the rest of the industry to, as well as creative solutions for those risks that are often described in supervisory highlights, that could be described in bulletins, I think it would make the ecosystem a lot safer. As I said, clarifying Reg E, fine, but guess what's going to happen? The consumer is still going to go to the financial institution. Tom will be the first one at the door if he has a problem with his Chase account, notwithstanding.
I'm a defense lawyer.
Yes,
I'll be answering the door, but
we'll be there. But I do want to go back to one thing on 1033. We don't think that that's the most pressing thing, but there are two things that really should be clarified. I would find it hard, Brian, having worked here in enforcement, to think that my former colleagues would believe that a financial institution would just have to blithely hand over the keys to the kingdom to a company that was obviously a sham. I would have a hard time advising my current employer to do that, and think that we would be fine from an aiding and abetting perspective. But I do think there's nothing in 1033 It states that financial institutions have to provide unfettered access to customer permission parties in whatever manner they choose, no matter how insecure or unsafe. And so, I think a rational reading of the statute is very similar to the First Amendment, right? Just as state actors can place time, place, and manner restrictions on your ability to exercise your free speech rights, so too should financial institutions have the ability to provide electronic access to customer permission parties in a manner that's safe and secure. Touching on a point, I think it was from the first panel on customer permission access and what you get to see. While it's clear that there's a lot you get to see, it should not be the case that proprietary data, and the way we would think of proprietary data, would be some of the same types of information that these services are trying to provide. Budgetary plans, investment analyses, maybe third-party license data like market data that we may provide to our customers. 1033 is designed to promote competition, that's what I'm hearing, and that makes sense. It's not designed to thwart it or undermine it by sort of blessing what would be an anti-competitive outcome. And then the third point, again, is that I think the CFPB should consider the implications of having a focus so primarily on access without the requisite examination and governance and credentialing and all of the things that you have in open banking regimes like the one in the UK.
So can I make a quick point on larger participant? So there are two institutions that are awash in consumer data that handle literally trillions of dollars of transactions every year, neither of whom has been designated a larger participant. Care to guess who they are? I know there are people here in the room from there. Visa and MasterCard. So it just seems crazy to start larger participant designation in this space with the likes of Plaid, Amex, and finicity. I mean, you know, I know that they all aspire to greatness, but the combined market cap of MasterCard and Visa is now approaching $1 trillion. If there's a larger participant in this space, it's them, neither of whom is regulated or directly licensed by anyone in the United States, just to sort of put a pin in it.
Yeah, Brian?
Yes, just to respond to Nellie's point, like, look, I don't think that 1030, I mean, right there, the very first words in the statute are subject to rules prescribed by the Bureau. So clearly, there is some scope for the Bureau to put some bars around this. The question, but I think the two questions are, is it just the Bureau, right? Or can can financial institutions kind of create their own rules? Could the Bureau, in theory, say, okay, financial institutions, you guys create rules and we'll just kind of bless them? And I think there's a scenario where the rules get so onerous that they intrude upon the core provision of, the core of the rule, which is that the consumer gets their information, right? And so that's the scenario where there is a legitimate question, right? But I'm not convinced that the statute goes, well, one, it definitely seems to discourage, at least, the CFPB mandating a particular standard, right? It doesn't expressly, I mean, you look at it and it says, like, we'll consult with the bank regulators and Federal Commission to ensure, to the extent appropriate, that the rules do not require or promote the use of a particular technology. So, of course, like, what is the to extent appropriate? I don't know. It would be, I suspect if we could go back to the Dodd-Frank Congress with, the world as it is now, we would get a different 1033. I don't know exactly what it would look like. It would be clearer, no matter, what it is. Maybe it'd be clearer to say, no, we're just talking about like online bank access. Or it might say, no, you have to do business with the Plaids of the world. I don't know which way the Congress would come down. But there's clearly something here, and there is some scope at which the Bureau can place meat around it, but I don't think it's unlimited, right? And I think we should look to kind of what is the big thrust of the rule, and I think, or big thrust of the statute. I think the big thrust of the statute is consumer empowerment, right? This notion that the consumer gets their data. I mean, we haven't even talked about like what type of data, and when it says use in electronic form usable by consumers, what does usable mean? How much work does usable do, right? I mean, I think my read on it is that it's read-only style data. It's not write, you have to go in and be able to edit or initiate transactions through this. I don't think they went that far, but someone might think that.
So mindful of the time, I'm just going to ask each of the panelists to give us sort of the quick parting shot, 30 to 45 seconds each, so that we can get everyone out to eat lunch. So let's start with Chi-Chi.
Quick parting shot. Well, I'm going to use a little time to respond to Tom's point. I mean, I don't think whataboutism is a good way to sort of regulate or deal with these issues. I mean, the whole larger participant, the larger participant scheme contemplates supervising entities that provide risk or that pose risk to consumers. And as we've talked about this entire symposium, there is a fair amount of risk to consumers from data aggregators. There's a fair amount of benefit, too. But the risks are buried, layered consents in mice type that people don't understand. I just learned an aggregator is involved with Venmo. I'm like, I didn't know that, and I'm a consumer attorney. And so I think there's a problem here. On the other hand, there's a lot of benefit, especially for, folks who are outside the traditional credit reporting system. So, it's a balanced approach. It's a devil in the detail, and if it's not addressed with guidance and regulation, certainly supervision, one of those approaches is necessary.
Tom?
So I don't often spend time thinking about or frankly litigating about the Second Amendment, and I don't particularly like the Supreme Court's interpretation. I would observe, however, that the construct of the Second Amendment is similar to the construct of 1033. Right, so it starts with a sort of broad qualification, right? So a well-regulated militia, right? And then it says the right to bear arms shall not be infringed. And in interpreting the Second Amendment, the Supreme Court has ignored the first clause and focused on the second. I think 1033 is effective today, that banks and financial institutions have an obligation to provide access to third parties and that they are generally not adhering to it. I think the CFPB should dispel that myth, and I think that the prudentials, and we haven't talked about them, should add a section to the FFIEC manual to make sure that all of them are comporting with it, and that should happen 10 years ago.
So we've got First and Second Amendment. If anyone wants to talk about quartering soldiers, then we can. Jane, any quick thoughts to finish up?
I'm going to leave the quartering soldiers. So Amex was founded 10 years ago on the mission of empowering the world to be financially strong. And fundamental to that mission is enabling people to access their data, to share their data with portability, but in safe and secure ways. Again, working with over 2,000 institutions, we work with their compliance departments every day, right? We are very, very familiar with the constraints with which both financial institutions and the wider regulatory world, needs to show up in protection of the consumer. We've said this to you in the room before, we've said it to other regulators, but as a significant participant in the ecosystem, we would absolutely be open to supervision if it's in the right frame of always protecting the customer and being, really working towards great consumer outcomes.
Okay, Dan?
Yeah, a few things. My organization advocates for consumer financial health, and so I think as a starting point, I would just sort of, going off of what Chi-Chi said a little bit, remind people that these issues directly impact that on issues like liability and indirectly impact it on issues like competition and innovation. Second, I would reiterate that this is an opportunity for the CFPB to weigh in. Everybody kind of has a pretty good idea what can be done, and everybody knows who can do it, and that's a rare opportunity the CFPB should not pass up. I also think in the long term, the CFPB has to remain engaged on migrating the ecosystem away from screen scraping. We've heard a lot about that today, or credential sharing, Tom. And that small banks and credit unions need to make sure they have the tools they need to engage in this ecosystem as well. And I also think there's a need for a broader effort to assess consumers' data rights beyond this access question, and really look forward to contributing to that in the year to come.
Okay, Natalie, Brian, one sentence each.
No broad-scale rulemaking is necessary. I think a lot of progress is being made. Think there are a lot of benefits, but also think that regulation and supervision is really important to protect against the bad actors, and we shouldn't set up a system just for, in a Pollyannish way, thinking that there will only be good actors.
How many semicolons can I use? Just kidding. All right. So point is, Congress did a thing. There's ambiguity. The CFPB should clarify while exercising appropriate humility. Clarification is not amendment. Maybe it was a mistake, but we need to get clarity as to what it means so that we can either enjoy the fruits of Congress's wisdom or go correct their mistake.
Thank you. As you can tell, we could have this discussion all day, but I'm sure you all are starting to get hungry. So thank you to our panelists. This has been a great discussion.
Thank you, Tom. And just one more time, round of applause for all of our panelists today and all our moderators. Thank you. Thank you for being here. Thank you for watching. And as a reminder, this will be a recording of this will be available on the website. And with that, thank you for being here. Have a great afternoon.